Okay, good afternoon. So my name is Abu Thahir. Okay, I'm a CMA qualified, and I've been teaching in ArivuPro from past 1 year. So today we'll start our CMA US Part 1 weekend class. So in this, we'll cover from July till October. We'll cover all your syllabus in Part 1. So part 1 in the sense financial planning, performance and analytics. So in CMA, we do have two parts, part 1 and part 2. So first we'll discuss about the CMA, how the syllabus is. So CMA, we have part 1 and part 2. Curriculum, certification, exam, everything is decided by IMA. Okay, Institute of Management Accountant. So these guys sets our curriculum, examination, membership, your certification, resource, all this is provided by the IMA. So when it comes to the syllabus, we have part 1 and part 2. So part 1, which is going to start now from the July to September, we'll try to cover the part 1 in the weekend batch. So Saturday and Sunday. Saturday we do have class from 2:30 to 8:30, and Sunday we have 9:30 to 3:30. So 6 hours class. A weekly, if we take, it's a 12 hours. So in this part 1, so which we are going to start, this is going to be financial planning, performance and analytics. Financial planning, performance and analytics. Before we discuss the examination pattern and everything, we'll completely discuss the part 1. So in this part 1, we do have 6 sections, A, B, C, D, E, F. Each part has its own 6 sections. You can, if you want, you can combine and study the sections. If you want, you can break down. But as per the textbook, we do have 6 sections, but it doesn't mean the examination you will get 20 questions from A, 20 from B, 20 from C. No, you can't even predict what they are going to ask, how it's going to be. So section A, which is straightforward, external financial reporting decision. It's nothing but your financial reporting. Like if you're already cleared your graduation, or if you have already done your PU, you would have like if you're from a commerce background, you would have known like accounting. What is accounting, assets, liabilities, all these things is going to be discussed in section A. So which we can also tell it's a basics. We can understand if it, okay, why this is asset, why this is liability, how to report it, how to prepare the financial statement. Everything is going to be on section A, which is rules. There are some certain set of rules. So this is asset, this is liabilities, because there is a rule. Because of the rule, this particular thing is asset. Because of a rule, this particular thing is a liability. So we have to understand the rule, which I can tell rules. Sometimes you have to memorize it. Memorize in the sense you have to understand. That's it. It's not like mug up, but you have to understand. Okay, understand the definition, and if anything they are asking on that, you have to tell, okay, this is that, this is that, this is this, and why this is this, why this is. Because here it's you will come up with n number of things, but the basic definition, if you understand, sorted. So that is what in the external financial reporting decision, which will start today. Then we have section B, which is planning, budgeting. Here it's a theory come practical. We'll do planning and budgeting here. Here it's not some set of rules or anything. Here we'll go through some theory parts, like understand what is planning, understand what is strategy. Then comes the budgeting. Budgeting means like suppose if you are running some business, or you want to conduct some event, or if you want to go a trip. So what you'll do, first you'll budget, tell this is our trip expenses, this much only we have to spend for the transport, this much only we have to spend for the entertainment, this much only for our food, like this, we'll plan something, right? We'll in terms of money, that is budgeting. Same way in a company, for the next one financial year, or for a month, or for a half year, they'll sit and do budgeting. That is what B says. In this, there is nothing to mug up or anything, no rules or anything. However, we'll understand concept clarity is required. Once a concept clarity is there, then easy. Then you can do a calculation on your own. It's not like first you do addition, then subtraction, then if you have a concept clarity, do whatever the calculation you want, but at last the answer should be correct. That's it. Next comes C, which is performance measurement. Performance measurement means, we told we did some budgeting, right? Whether we achieve the target or not. That is what this section says. It's a very easy section. It says whether we reached there or not, why we haven't reached, who is the problem, who is responsible for this. That's it with the C. Okay. So after we cover the B, then only we can cover the C. Next, we can go to the cost management, or cost measurement, or cost management. Here we'll learn about the costing, how to measure it. We'll tell, to manufacture this table, it is 1 lakh. How it is 1 lakh? Why? Because to manufacture this table, we want wood, we want some material, a labor guy should come and do the work, but it should have used some electricity also. How much electricity should we assign to the table? Different types of allocations, how the cost is assigned, everything is going, it will go in section D. Then E and F, it's complete 100% theory. E and F, a very small syllabus, 10% and 15% it has. E is internal controls, and F is technology related. Okay, so E is nothing but like an auditing, like it's whether everything is going good or not, whether everyone is being honest or not. Telling that a manager is coming, telling that okay, work is going good. Who will ensure this? Some control should be there. We are telling that okay, the assets are safe. How it is safe? What lock system you have used? Whether this lock system is working or not? Whether it has some problem or not? That's it. Whether the internal control is. F is related to the technology. So as we know, right, AI, blockchain, cloud computing, we have no one writes an accounting in the paper. We use a software. So how this accounting system works, what and all required in accounting system, and system development life cycle, and we learn about virus, all this related to the technology, which is very odd from other sections. Okay, we'll clear that. We'll clear E and F later. So when it comes to A, B and C, D, it's about a practical. Okay, and in this you can take separately A, and B, C and D you can group it in one, because these three are correlated. If you want to measure something, telling that we achieved the target, first what we have to do, we have to set the target. So target will be set in the budgeting. So without you are doing budgeting, you can't do measurement. So we can clear this. And to budget and to measure, you should understand how to calculate. So who will teach that? Cost management will teach that. So like this, B, C and D is related, and A is different. A, why I am telling different is because I told you it's rules. B, C, D is not rules, it's about concept. A is also, there is a concept, why there is a rule, certain rules are made, logical rules is also there. Why I am telling rules is, suppose some rules in India, here it might be legal, in other country it might be illegal. Same way, there are many certain rules in each countries they are following in the accounting also. In India, we do a different type of accounting. In US, some base is same, but few rules are different. When it comes to ACCA, they follow different. When it comes to CMA US, we follow different. In India also we follow different. Okay, but the base would be same. But that is the reason I'm telling A, you give a separate chance. B, C, D, you jumble it together whenever you're planning for your exam, whenever you're studying. B, C, and D study together. Don't bring A in between this. A, you keep it separate. B, C, D will do it a separate set. E, F will do in a separate set. Like this only we'll cover our class also. A will do first, B, C, D will do later, then E and F will do at last, which is completely theory. No, not even a number is involved in it. Now, this is that. When it comes to part 2, which is strategic financial management, which is nothing about talking about the finance, money, how to manage money, how to there is no rules, nothing. You should understand like your personal finance, how you will manage your own money, right? Like that, how you are managing the company's fund, where to get the fund, to whom like from where we have to borrow. So like this, all these things are involved in part 2, which no need to worry about right now, but understand it. So what is there? So it's purely about finance. But once you're clear with part 1, right, your part 2 section A will be easy. When you know how the income statement balance sheet look, in part 2 it's about analytics, telling that whether this company income statement is good, whether this company income statement is good. Which one? Part 2 will tell which company is better. Here, a part 1 in section A, we are providing the income statement. We tell this is the income statement. To prepare this income statement, you want the help of part 1. To analyze the income statement, we want the help of part 2. So there it's about analytics. Here it is about, like, there you take a decision, moreover, whether this company I have to invest, whether I have to invest in Reliance, whether I have to invest in Adani, whether I have to invest in Tata, whether I have to invest in Mahindra, whether I have to invest in Axis Bank or SBI or HDFC. Like this, moreover an investment point of view, moreover money point of view, where like more interesting. But here, yeah, as I told, A is more about rules, B, C, D is more about inside a company, whether you have to produce a table or you have to like produce a chair, which is more costlier. What is the price you have to fix? You have to set some price, right? So what is the price you have to fix so you can cover the cost? Sometimes if you price higher, what will happen? You will make a profit, okay. But what if the customers are not buying? What if you're keeping a price very lower? You'll make a loss. You will not even cover the cost. So those things you will learn here. And if any company you take, they will have some budgeting, they will have some target, they will have some certain goal. So we will set the goal here. So part 1 is about preparing a financial statement, understanding management accounting inside a company, how everything works, and about internal controls and technology. Okay, now we'll come to the examination part. So each part 1, part 2 you have to give separately. In the sense, in a single window you can give together. Suppose in a year we have 3 windows: Jan, Feb, May, June, September, October. In a year, you can select any of a window. Window means in Jan, Feb, in this from January 1st to February 28th, you can select any date, whichever you want. You can go, you can attend your exam and you can come back. And if you want to give a 2-part, you can give on like in this particular Jan, or if you want to give on a different window, yeah, you can give. That won't be a problem. So as your we are going a class from July to October. If you want, in October we'll complete the syllabus, right? If you want, you can give your exam in the month of October, or you have to wait till Jan, because by October 2nd week we'll assume that we are complete by first week or second week. Still you have 15 days time if you are practicing from today onwards only, or if you are lagging behind or something, then you need at least a revision for 2 months, then you can give in Jan or Feb. So based on the slot available, you can select your location and you can give your exam any day. It's a 1-day exam, 4 hours you have to give. So it's only 4 hours exam. So in this 4 hour, you have 1 hour and 3 hours. Okay, 3 hours for MCQ, which you have to attend 100 MCQs. Okay, so any day you can pick, go to an exam, or you will be given a 4 hours. In this 4 hours, 3 hours is for the MCQ and 1 hour, I'll tell you, like in this 3 hours, you will be given 100 MCQs. So 100 MCQs you have to solve within 3 hours. Okay, it might be practical, theory, jumbled. I'm not sure which section you will get. No one can't tell. You will get 10 questions from section A, 20 questions from section B. No. Same day you go and your friend go or someone else go, you might get a different questions. It's not that both will get a same questions. So you feel, suppose you feel section E is tough and it's very boring. I don't want that section. Okay, what if section E is being asked more? Like, assume that they are asking, unfortunately, 25 questions from section E. It can. Then what? You lose your exam. So we have to give a equal importance to all of the section. Either it's a theory, either it's a practical, no matter what it is. We have to give an equal importance to all of the sections. Okay, because we don't know from where they are going to ask. Next, we have 1 hour. In this 3 hour window, you have 100 MCQs, at least 50%, and a quantity wise, not a quality wise, 50%, which means at least 50 questions you should answer correctly. Then only you can go to this window, case-based question. Case-based question. Initially, it was an essay. Now it changed to case-based question, which is more easier. Essay in the sense, initially now it got they discontinued it. From next window onwards, it's a case-based question, so no need to worry about the essay. So essay was like you were getting 2 essay, 2 stories you were getting. In the 2 stories you are having a 6 questions where you have to type. Essay doesn't mean like 200 words essay, 500 essay, not that one which we are having in the school. Here, essay in the sense, you will be asked to calculate cost of goods sold. Then you have to write in MCQ. What you have to do, you write in a rough paper, you will get an answer, you tick A, B, C or D. Here, you should use that calculation in your screen. You have to type it on the screen, telling that, okay, this is the formula, this, okay. You have to present it, not in a if you're writing in a single word, no. You might get but lesser mark. You have to present the entire calculation. And when it comes to, suppose they'll ask, what is blockchain? So you have to type what is blockchain. But in a MCQ way, they'll give a story and tell what is this. In MCQ, they'll explain this, what violated, which rule it is, like that. Here you have to explain the rules. That's it. But right now, no need to worry about the essay. Now it's case-based question. Here also it's same. You will be given 2 case studies. 2 case. So 1 case studies will have 4 or 5 questions. In that 4 to 5 questions, you no need to write as in a like an essay, like a fill in the blanks. Just do in a paper, put in the fill in the blanks, like a match the following. You have to match the things. Or you might have a multiple answers, multiple choice question. So in this multiple choice question, A, B, C or D, one option you have to select. Here they'll tell choose 2 correct answers, like that. So one more advantage in the CMA US is you don't have negative marking. So whatever you do, like if it is wrong, that's it. No negative marking, so no need to worry about this. So this is about the exam. So 4 hours, but to get in this case-based question, your MCQ you have to do it like a 50%. Now when it comes to the mark, so the total mark for your 4 hours complete examination is 500 marks for one part. Okay, 500 marks for one part you will be having. In this 500 marks, you should, to qualify that particular part you have qualified, you should score at least 360, which is passing mark. So might be in your BCom or MCom, whatever it is, if you pass 35 in 100 or 28 in 100, you will pass. Just 28%. Here it is not 28, here it is going to be 360, which comes more than 75%. Okay, so this will be your target. So yeah, so when it comes to part 1 is financial planning and performance, you will have same 100 MCQs, two case based question, but you will be given only 1 hour. Okay, and in this 1 hour you have to attend 2 case based questions. So before we are worrying about the MCQs and case based question, if you have concept clarity, done. Okay, sorted. So clear with the exam. Now what are the things we have to do is, first is concept clarity. Do more MCQs. 3, we can focus on mock test. Then we'll evaluate all this and understand where you are standing. So based on this, then you'll understand, once you do evaluation and everything, you'll understand whether to take an examination or not. Okay, because when it comes to examination, suppose if you are a student or you're not a student, 2 categories: either you are a student or you're not a student, might be a professional, or might be you might be not working. The IMA doesn't worry about that. If you are a student, you can take a student membership where the IMA will give 3 years membership for you. 3 years membership. So if you pay once, you'll get for 3 years membership, where it comes around 25,000 approximately, based on the exchange rate, because we have to pay in dollars. Okay, so here if you are a student, you will get 3 years membership, but if you are a professional, you will get only 1 year membership. So here you have to renew each year. Okay, next, for examination you have to pay separately for part 1 and part 2. Here also part 1 and part 2 you have to pay separately. Before you take an exam, you have to get the membership. If you get the membership, you'll get an access to their website, to their resources, to other like a global CMA forum, like you will get connected with other members, and you can take the exam, all those things. Whatever the seminar or any live session they are conducting, you can participate in this. When it compared to students, professional category will pay more. Suppose if you are doing your BCom or MCom, or if you are on a final year, the first job you have to do is take the membership under the student category. Or if you have completed and if you want to go with a professional, okay, you can go with a professional, where, as I told you, it's little bit compared to student more costlier, not little bit more costlier, and you have to you will get only 1 year membership, so you have to keep on renewing membership. Okay, so that is, suppose like from ArivuPro, if you take, as we are a silver member, you might get some discounts and you can apply that and you can get it done. So that's it with the examination, syllabus, everything. Okay, so we'll start with part 1, section A now. Still here, any doubts or question? Clear? Okay, so in this external financial reporting decision, which is your section A. Okay. So these are the topics we are going to cover. So these are the topics we have in the section A. So in this external financial reporting decision, it's all about preparing a financial statement. Okay, how to prepare a financial statement, what are the rules, why it is asset, why it is liabilities, and all those things. Okay, in this I like categorize into 6 topics. So first we'll discuss about the statements, what and all we have. Like we all know the statements, right? P&L, balance sheet, we are telling, income statement, balance sheet, cash flow statement, and statement of changes in equity. So these are the statements we are going to learn first. Then we'll learn about the current assets. Current asset means not only one current asset. So there are multiple current assets, right? Like account receivable, inventories, cash, investments, few investments we do, those things. Then we'll come to non-current, like plant, property and equipment, depreciation, and valuation of this. How much value should I write? That will be a question, right? So I purchased the land 10 years back. Now the land value would have increased. So how in the financial statement, what is the rules? Whether we have to increase it or decrease it, whether we have to depreciate it or not. If it is, what depreciation we have to use, that one. Next we have a liabilities. Same this side, if we go, how we should write our liabilities, when it is a current liability, when it is a non-current liability. Then equity part, owner's money, how the owner's money change, who, like how you will get the ownership. Like there are 2 types of equity: preferred equity, common equity, preferred share, common share, those things. Then we have revenue, income, how to recognize the income. If you get a money, you can't tell you earned it. So when you will earn it. Impairment means, impairment recognition means the asset value will go down, right? So when the asset value is going down, you have to write down the value. So when you will write, at what amount you have to write, whether can you, suppose if the asset value is increasing, whether can you increase or not. All these things we are going to discuss in this particular section. So in the section A, first topic I told, so section A is about external financial reporting decision, or we can tell financial reporting. Report the finance of the company. Okay, so how you will report this? By using the financial statements. We call basic financial statement. So why do we report this? What is the use of reporting this? Suppose I am running a company. Why I have to report my financial statement?
Showcase to the shareholders to compare with other companies'
how we are performing, right? So to show to the shareholders that, see, you gave us the money to run the business. See, we are running the business, and this is what our income is. This is what our profit is. This is where we stand in assets. This is where we stand in liabilities. That is what we are going to show in our financial statement. The primary reason. One is to the shareholders. We can't tell it to the shareholders. We can tell like this as a resource providers. Do you think only shareholders are the resource providers? banks, they will give loan to us. So even if the bank is like trusting you and giving the loan, so the banker has to know that how much money you are making, or you are investing in the company's bond. Like you gave a loan, you yourself gave a loan to the particular company, so that person has to know how I'm a company performing. Based on that, my company share value, bond value keep on increase and decrease. Okay, so the primary objective of the financial reporting is to provide financial information about a company for external resource providers. Why they will use this why this resource provider will use the financial information to take decision about allocating capital to the entity, whether to invest in this company or not. If I have already invested, whether I have to sell this or I have to hold this. We can tell the potential investor. Potential investor means a person who want to invest. So what he will do? He will check your financial statement and tell, okay, I will invest or I will not invest. How he took the decision? By checking our financial statement. So these financial statements are prepared by using these standards or rules called as IFRS and US GAAP or US GAAP. Either a company can prepare their financial statement in IFRS or US GAAP. Okay. US GAAP is a rules mandatory for United States based companies. To whom? United States based companies, and also to whom? Any foreign entity who's trading in US financial market. Not only for US companies, any foreign company, any non-US company who's trading in US financial market. Trading means their company's shares are selling in US financial market. Okay, so for all this company should follow what? US GAAP. Okay, so mostly this US GAAP, what a full form of US GAAP is, like GAAP means generally accepted accounting principle. Generally accepted accounting principle. Where? In the US. Okay. Next we have an IFRS. So this is International Financial Reporting Standard. This is globally accepted framework. It's a framework. Here its principles, here it is a framework designed for who? Multi-country use. They can diverse it according to their culture, legal and commercial landscapes. Based on each country, they can change it. In India, what we follow? Yes, what accounting standard? Yeah, in the name itself is there. Indian accounting standard. Okay. So in India, we follow Indian accounting standard. I think we took a framework from the IFRS only, because IFRS, it's International Financial Reporting Standard, were used in a multi-country. According to our culture, according to our legal rules, we have changed it. See, as this IFRS is designed in UK, but in UK we do have a different rules, and in India we do have a different. So we'll take the IFRS but change accordingly to our legal system. Example, we take our labor hours might be different, and our bonus might be different. This much bonus we have to give to the employees. This is what the salary called. This is what an incentive called. Like this, we do have a different labor laws, right? So based on that, our accounting system will also change. This will go to, in this cost of goods sold, this will go to other expenses. Like that it will come. Okay, so based on that. So these are the major differences we have, US GAAP and IFRS. So the core philosophy of US GAAP is it's rules based framework. When it comes to IFRS, it's principle based framework. We want to put in an example. So US GAAP is more strict. Suppose a parent is telling to a child, you have to come to home before 9 p.m. or on before 9 p.m. you should be at home. This is what US GAAP say. But IFRS will tell you should be at home before late night, or be professional in your timing, manage the timing professionally, like that. So you can change accordingly. But the framework is there, what? We should be professional at the timing. We should not roam late night. This is what a parent is telling to a child. But here US GAAP tells 9 p.m. last. So you should not, if it's going above 9 p.m. no, they have violated the rules. But here, okay, something which is professional, we can accept it. That's what the framework. So a person living in other region, for one parent, for one child, if a sunset is very late, okay, we can consider 9 p.m. is not that late night. Here in some places sunset is very early. So from them, if 5 p.m. only it's getting sunset, 9 p.m. is very late night. So based on that, the IFRS work. So based on your culture, legal and commercial, you change it. But US GAAP, it follows in the US, right? So we have 9 p.m. at 9 p.m. So US GAAP, you can't, it's not flexible. It's very rigid. But when it comes to IFRS, it's principle based framework. So you can change. Okay. Your interpretation, actively interpreted, updated, heavily policed by a standard setter and regulatory body. Someone is there to actively look into this, where in the US GAAP. But here, left broadly to the professional judgment. Judgment wise, you can change whatever. Individual companies and external auditors, you can change whatever by the judgment wise. But the framework is there. Don't think it's very free. Framework is there, but accordingly you can change it. Next, consistency across entities. Here there is high uniformity across different companies. Uniformity is there. Here, depending on industry, geography, specific corporate policy choices, it change. Okay. Here the geographic target is for whom? US based companies and a foreign entity trading in US market. Here it is for the multi-country use. Which one? IFRS. So based on these rules, we are going to prepare the financial statement. So mostly we are more focused on US GAAP, but some standards we learn in IFRS also. When we are discussing about the inventory, we'll discuss in US GAAP and we'll discuss in IFRS also. Some is allowed in US GAAP, some is not allowed in IFRS. So like that we'll understand the difference, and at last I'll share you the PDF which says what and all we discussed the IFRS versus US GAAP. We'll discuss that in a last class at last. But each topic when we go through, we'll discuss on each topic. This is a difference in IFRS. It's not that we are learning two standards. Not everything we are going to learn. Some part when it comes to current asset, how we record, how in IFRS record, that's it. But more focused on US GAAP. Okay. Now who uses the financial statement? We already discussed. Here we'll learn who are the internal users and external users. So we are going to prepare the financial statement based on the rules. Got it? Who use this? Who are the users? How they are getting affected because of this is the topic. Users of financial information. Okay. So they use financial reports to judge what? Amount, timing and uncertainty of the company's future cash flow. They'll judge how much amount they are going to earn, when they are going to earn, what are the uncertainties we have in this company. To understand all this, the users will use financial information. So we can put this users into two dimensions: internal versus external, direct versus indirect. First we'll discuss about who is internal and external users. Two dimensions, okay? The users we will covering into two dimensions: internal versus external, direct versus indirect. So in the dimension of internal versus external, who is internal users? Inside the firm, which is managers, who use the data to make internal operating decision, to decide whether to do this or not. They use this financial information. Mostly they'll use management accounting information. We have two accounting here: financial accounting, management accounting. Financial accounting is for externals. Management accounting reports will not go to externals. Example, we take Samsung. Samsung planning to do something, but they will not provide externally. That is for whom? Managements. So that is management reports or management accounting, which is BCD. B is about planning, performance, costing. This is not given to externals. This is given for internals, who is operational manager, to decide, okay, to do this or to do not. They are internal users. They use financial information to take a decision inside the company. And next comes externals, parties outside the firm who use data to decide whether to start, continue, or terminate a relationship with the business. Whether I have to invest or whether I have to continue investing, or whether I have to stop, take my money back with this particular business. Don't think only about investors and creditors. There are many suppliers, customers, and employees. Sometimes employees also use, because employee want to understand whether the company is performing well or not, whether can I get the bonus, whether my job is secured or not. Some few companies will give employee stock options based on the profit they achieved. So how will they come to know? A lower level employee, how will come to know the company made profit or not? They'll go to their website, download the income statement and see. So these includes who and all: investors, lenders, financial analysts, and investment advisors. Sometimes government also use, and bond rating agency will use. Bond rating agency means the agency who decide our company's credit score. You can tell like that. We have our CIBIL score, right? The company will have CIBIL score. This is called as bond rating agency. They will tell, oh, this company will give back your money. This company will doubt. This company with high risk. So these bond rating agency will tell. They will rate A, B, C, D, telling us, okay, this company you can get back your money on time, no problem. Some tell, oh, we have a certain doubt. So they will rate accordingly. So how they will rate? If they want to rate, they want our financial statement, right? So these bond rating agency will use. These guys are externals. Next other dimension is direct versus indirect. When it comes to direct users, this directly impact financial success or failure. These direct users will lose money if the firm is crashing. The direct users will lose money because they are investors, lenders, suppliers, employees, and management. Indirect users, they do not lose personal money directly, but they represent or advise direct users, like stock market, financial analyst, market, regulatory body. See, suppose if a company is crashing, will the government will lose money? No, government will not lose money. So they are indirect user. If you are an investor, will you lose the money? If the company is crashing, yes, you will lose the money. So you are direct user. So we can tell a financial analyst is an external user and indirect user. In the two dimension, one dimension is internal versus external, direct versus indirect. In the dimension of internal versus external, financial analyst is an external person, and in the dimension of direct versus indirect, a financial analyst is a indirect. Clear with this two dimensions, how we have categorized it? Okay. Now we are telling that financial statement. What are the elements makes the financial statement? Like we can tell it's like ingredients which makes a dish. So what are the ingredients? What are the elements are required to make the financial statement? We told there are financial statement, right? What makes this financial statements? So there are a lot of things this tells, but we'll put it in a simple word. In a financial statement, what and all will be there. When we have assets, then we have liabilities, then we have income, then we have capital, then we have expenses. Okay, so these are the 5 elements: assets, liabilities, income, capital, and expenses. Okay, so we put in a mnemonic this ALICE. Okay, in the form of allies, we'll learn assets, liabilities, income, capital, and expenses. Okay, so this assets, liabilities, and capital will go in which statement? Balance sheet. And income and expense will go in the income statement, profit and loss account or income statement. Okay, so in this, elements of financial statements are like a building blocks of financial statement, which are assets, liabilities, and equity, and income and its components. Comprehensive income and its components we'll discuss. We have a topic which is nothing but income and expense only. Why they are giving a different name is there are a lot of things. A components of comprehensive income means revenue, expense, gains, and loss. Not all gains are revenue. Correct. Not all gains are revenue. Because revenue is certain different thing, gain is different thing. But both are income. So you can put in an umbrella term. In income, we can tell gain is also income, revenue is also income, expense is also expense, loss is also certain expense only. So that only in the allies mnemonic. E means expense and loss, I means like revenue and gains, both comes. Okay, which means it a component of a comprehensive income. Okay, now this income, what does the income do? Like suppose if a company is earning, who is earning that? Shareholders, owners are earning. So comprehensive income means anything which is increasing equity. Increase in the equity is comprehensive income, but except owner activity. Suppose owners are investing in a company. Is it an income? If owners are investing in a company, is it an income? It's a capital. It's not an income. But is it increasing the equity? It's increasing the equity, but it's not income. So income means what? And comprehensive income, a change in asset and liability, which means a change in equity, other than those result from investment by owners or distribution to owners. Anything which is increasing the equity other than what? Invest from the owners or withdrawal from the owners or distribution to owners, everything is called as income. I mean comprehensive income. I'm not putting in a single word called income. I'm telling a comprehensive income means what? A change in equity other than investments from the owners or distribution to owners. Because if owners in investing, equity will change. But is it an income? No, because we told other than. And if you are giving a dividend from the fund, from the equity we are giving dividend, what happened to the equity? Equity will go down. But does that mean it's an expense? No, it's not an expense. Why? Because the owners are taking. Okay. So we have a detailed formulas and everything, but understand now what are the five. Now in this topic we'll understand what the 5 elements we have. One is assets, liabilities, equity, income, expense. So when we understand how it's changed, one, because we know that accounting work in a double entry system. One in, like, it will be not like only asset debit. Something debit, if there is a debit, there will be a credit. Here we no need to worry about the debit and credits, but understand how these 5 elements are changing. That's enough. If there is an expense, what happened? Expense is increasing. Then what happened? Asset might be decreased. So like this, you have to understand the effect. You no need to understand the names or anything. That's secondary. We all know what asset is going to decrease. But any transaction you take, check how it is affecting the balance sheet, or how it, my balance sheet should get tally at last. Suppose paid electricity bill. What happened to the asset? Asset will go down because we are paying a cash. Okay, asset side went down, but we know that if asset is going down, it will not get tally because liability and equity is there this side. Now when there is a expense, what happened to your income? I mean, comprehensive income will go down. If comprehensive income go down, who is going down? Equity is going down. Then equity went down from left side, asset went down from the right side.
So expense will come with
P&L
so the net profit will go down.
go down.
So carry forward to the balance sheet.
Equity. So equity, what happened to the equity? Equity will go down, decreases. So equity decrease, this side asset decrease, so balance sheet tally. So like this, we'll discuss in detail, but I'm telling you, like this, it's a effect works. Any transaction you take, you see the effect, at last my balance sheet should get tally. Okay, nothing complicated. So these are the 5 or 4 financial statements we are going to learn in this basic financial statement topic. One is balance sheet, then we have income statement. So balance sheet, we do have another name. So please understand this name also, because in the MCQ you might ask with this name also. Statement of financial position. Either we can call it as a balance sheet or statement of financial position. Next, statement of comprehensive income or income statement. Statement of comprehensive income or income statement. Next, the third one, it's a statement of changes in stockholders' equity. Equity means owner's money. So in the owner's money, what and all changes happened, that we are discussing in this third one. So this will take a help of balance sheet. By taking the help of balance sheet, we'll create this third one. Next, we have statement of cash flow. It takes the help from the balance sheet and income statement. We'll prepare the cash flow statement. This will be done at last. So first we'll go in the number order only. First we'll create that. Once done with balance sheet, we'll go with income statement and equity, then cash flow. Any doubts still here? Clear with the elements, clear with the users? What are the 2 rules we have, US GAAP and IFRS? Okay. Now we'll go. Yeah.
So in the US GAAP rules, accounting rules, you have said US-based companies and foreign entities trading with US companies. So it's only the selling and purchasing of shares. Not the products or the
No. Only this shares. Because suppose assume that I'm a person who's selling some product to US company. Okay, so US country. So like that won't be a problem, right? Because they are not resource providers. If the resource providers are from the US, then you have to. Or I do have a supplier, means the supplier is also resource provider only, but we are not trading at the US stock market, so that won't be a problem. So any foreign entity whose shares are traded in US stock market, they have to use US GAAP, or else they can use their own countries, whatever it is. Okay. Now to put in this financial statement, any item should be recognized in the financial statement. It must fulfill all this condition. We have these 4 conditions, then only you can put in this financial statement. The first statement is, it should meet the definition. We told the elements, right? It should meet the definition of an element. This one is an asset. Why this is an asset? Okay, it's meeting a definition, put in asset. It's a income, put in income. So the definitions will learn. It should meet the definition of that particular element. Okay. Anything you take, any transaction you take, it should meet the definition. Then only you have to report in the financial statement. Next, be measurable. It should be numbers. Because in the financial statement, we are not going to write a letters, right? Like in words or something. We are going to put in the numbers only. It should be measurable. If it's not measurable, no, you can't. Third one, it should be shown. Demonstrated means it should be shown and measured with faithful representation. With faithful representation, you have to present this. Okay. And the fourth one, be representationally faithful, verifiable and neutral. Which means third and fourth one I'll explain. Suppose if there is an incident or a crime happen, what in a court what they will ask evidence. So that is third one. We should provide evidence for that particular entry. Only evidence is not enough. You should tell that evidence is faithful, or it's verifiable, or it's neutral. Example, there is a CCTV footage you are providing, so that's a evidence. Then you have to provide, like you have to tell the CCTV it's not compromised. I mean, it's not edited by someone. It's not alterated or anything. So we'll go to some cyber security person. They will give the certificate telling us this is original CCTV. So same way, the third one is providing evidence. Fourth one, it says it's verifiable, telling that if something transaction is there, or you should have some invoice you should have, and that invoice should get verified. That should be there. And you're telling tomorrow you're going and telling the land or a building value I bought for 1 lakh, now it is 1 crore. You can't go and write simply 1 crore. Should prove that, telling that okay, this is a proof. Yeah, that is called as a faithful representation. Okay. So if you are meeting all this condition, then it will go to your financial statement. So financial statement are prepared under going concern assumption. What is this going concern assumption is, my company will not close in a very near time. It's called as going concern. My company will be operating for the foreseeable future. I can't tell till when, but I can see my company will operate. Based on this, but we don't know whether it will operate or not. But we have to prepare our financial statement based on this assumption only. But if you are not prepared based on this assumption, then you can't tell current like non-current liability. Every liability will become current. Everything you have to pay today because you are closing the business, right? So because of that, we have, whenever we are preparing a financial statement, we have to assume that our company will run till the foreseeable future, which means that entity is assumed to continue operating indefinitely, that it will not be liquidated in near future, will not close in near future. Based on this assumption, we have to prepare the financial statement. Clear with the conditions and clear with the assumption, like based on what assumption we are going to prepare the financial statement. Okay. Next, we have a measurement and valuation of financial statement item. So there are a lot of valuation methods we do have in the financial statement. So what are that valuation method? We'll check that. Because here, if we understand these terms, right, whenever we are going to other topics, we'll tell historical cost. We'll tell net based on the net realizable value, based on the NRV, based on the market value, based on the replacement cost. We'll tell the terms only, because there are certain conditions. We'll tell you have to write this asset based on NRV. So then you have to write it in NRV only. You have to write this based on historical cost. Then you have to write in historical cost only. So that only it says US GAAP does not apply a single valuation method. To every item in the balance sheet, it has a different valuation method we have to follow. 5 distinct measurement attributes are utilized depending on the nature of the asset and liability company is operating. Based on the nature of the asset, the valuation method change. Example, I have a building and I have an inventory. Inventory, so whatever I sell. Okay, I have a building and I have an inventory. Is the asset nature is same or it has a different nature? Different in nature, right? Because the building, wherever I'm doing on operation, I'm not going to sell this, and my job is not to sell that building. My job is to sell the inventory. Suppose I'm manufacturing tables, I'm selling the tables. So both have a different nature. This I will keep on selling, but this I'm not going to sell. I'm keeping in the balance sheet like this only. So we do value this in a different method, this in a different method. Okay, because both are different in nature. And there are some other asset. Example, account receivable. Account receivable we are not going to sell or something. So it is written based on whatever I'm going to get. Example, put it in an example. I have an 1 lakh account receivable, $100,000 of account receivable. So I'm telling, can you tell like all 100,000 can I get? No, there will be bad debt. So that is a different types of valuation method. There you can't tell 1 lakh I will get complete 1 lakh. There you will apply different valuation method. Okay, so this is how in US GAAP we follow different valuation methods. So these are the valuation method. One is historical cost method. Major disadvantage of the balance sheet is also this method only. We value few assets in historical cost method. So those assets are PPE, plant, property and equipment, and most inventories are recorded the cash equivalent amount paid to acquire them. PPE means a plant, property and equipment is recorded on the historical cost, and most inventories are recorded based on the amount we paid. Then we adjust for depreciation, amortization and other allocation. Then what we'll do for the PPE? Like if we have a land or like not land, if we have a building, a motor vehicle, furniture, we'll do depreciation. And for the inventory, we never do depreciation. We have some allocations, and amortization is done for intangible assets, like patent, goodwill. We have a discussion on the goodwill because goodwill is a different topic, and goodwill amortization is not done because there are certain set of rules to do the amortization.
Sells the, only the company closes it.
No, amortization comes for intangible asset.
Yeah.
Depreciation is done for tangible asset. Amortization is done for intangible asset. But there too, when you have to do amortization, we can't do amortization for all intangible assets. Certain rules are there to do. So those things will come. So historical cost method is you record based on the amount you purchase. Suppose I purchase this building for 1 lakh. I record 1 lakh. Then I'll do what? Depreciation. This is what historical cost method says in assets. In liabilities, obligation to deliver future goods or service to a customer reported at value received when the liability was incurred. In the historical cost method, suppose I borrowed 1 million, I'll record 1 million and adjusted for subsequent performance allocation, and we'll keep on adjust this. Like we'll do an adjustments and everything. But how is recorded? Based on what I received in liability. In asset, how I'll record? Based on what I paid when I purchasing. That's it with the historical cost. Current replacement cost is here in the asset only. Suppose if I want to replace this asset today in the market, how much I'm going to get? Suppose I had an iPhone, I purchased an iPhone for $500. Historical cost method, I'll write 500. Current replacement method is, suppose if today I want to go to a market and purchase the same iPhone, a new, same means not used one, a new iPhone, might be because of the discounts or because of the market, the price would have fell down, right? So that is called as current replacement cost. Today if I'm going and replacing this asset, how much I'll incur. So reflect the cost required to replicate or purchase the identical asset today. If I want to purchase a new asset today, so this is called as current replacement cost. We'll use in different situation. Next is current market value. This is for marketable securities. Marketable securities is I have done an investment. Asset, for me it is asset, right? Because if I'm doing an investment in some other company, for me it is an asset. But we all know that the stock price keep on changing. Suppose if I invest, assume that I have invested in Apple Incorporation. I have invested, like when I was invested it was $250. Today it is $251. So stock price got changed. So it is majorly used for current marketable securities. So if it is changed, I can change it because my stock price, my particular investment value increased. So this type of asset will put it under a current market value. Then you can't, here for this asset you can't use the historical cost method. I purchased for 250, I will keep 250 only. No, because this type of asset we use current market value. So it is also utilized to write down the asset to reflect losses. What are their expected? Whenever increase you increase, decrease you decrease. That is what current market value says. For liabilities also, a highly volatile obligation such as option return or common stock short sold. Your derivatives, options. Suppose we can tell like this. Liabilities means short sell means what you know. First you sell, then you buy. Usually stocks what will do? Will buy the stock, then you sell. Correct. Here you sell the stock first. You first what you do, you sell, then you buy. Here also you have loss and profit. Our agenda is what? Buy at low, sell at high, then only we'll make a profit, right? Now what we would have done, we would have sold for 100. Then our aim is to buy for how much? Below 100. So that is, we call it as sold short or short selling, will tell. In part 2 we'll learn about this, but to give a short selling, this is how it is done. It's possible. You can go and sell Axis Bank shares today and you can buy on next Monday or whenever you want. Okay. But as an investor, what I want, I have to sell at high and buy at low. So then buying becomes my liability. You have to buy it at whatever cost. So because of this, there will be a changes in the value. Suppose I purchased for 100. Now it is going by 105. Sorry, I sold for 100. Now it is going for 105. Then I'm making profit or loss? Loss, because below 100 is my profit. So then you have to report that based on the current market value. So understand this. Current market value means whatever the value of that particular asset in the market, that is a current market value. Suppose if I am going I have some used iPhone. I want to sell that used iPhone. That is current market value. Okay. Current replacement cost is not used one. A new one, if I want to go and buy, then what is it? Next is a most important one, the net realizable value. We call it as NRV. In a short, we can tell it as an NRV also. Suppose I have that used iPhone, right? I want to recycle it. I want to scrap that, or I want to give it minimum. I'll get some price, right? Minimum. At least someone will buy for $100, right? That is net realizable value. Minimum amount I am getting, that is net. At least I'll get this much if I'm selling that phone. That is net realizable value minus any expenses. Suppose I am able to sell that for $150, but the buyer told you have to ship it and you have to pay for that shipping. So how much I am going to sell this for? 150, and for shipping, if I'm paying like $10. So net realizable value is how much? 140. So the formula for net realizable value is selling price minus cost to sell. Selling price minus cost to sale. Then we'll learn the term called undiscounted amount. What is this undiscounted amount? Okay. In the name itself is there. Undiscounted, discounted. Two amounts are there. One is because in the lease, we are going to use this undiscounted and discounted. You have attended part 2, right? So you know what is discounted money. Like we are discounting the cash or any money, whatever we are going to get in the future, we are discounting. So in the name, whatever it is there, discounted and undiscounted will be more, or discounted will be more? Undiscounted will be more because it's not discounted. Assume that undiscounted is 1000 and discounted is 900. Okay. So net realizable value, we have to write in undiscounted amount, which means you have to not discount it. What is this discounted? Discounted means in future I am going to get 1000 rupees. When I am going to get? In future. And I have to convert the 1000 rupees in today's value. So in today's value it will be more or less. Example, tomorrow's 1 lakh value is more or today's 1 lakh value is more? Tomorrow's 1 lakh value will be more. What does the time value of money say? As time goes, money value is decreasing. So that is the reason I asked the opposite. If I'm asking in a right manner, you will tell, oh, tomorrow's value will decrease. But I'm telling today's, because that is how we'll discount it. In today's value, the value of money will be more than tomorrow. I mean, than future. So suppose the value will be 1100. So in future, how much I am going to get? I'm going to get 1000. But today the value of the 1000 is how much? 1100. Okay. So this is how it will be. Today the value will be 900. Today's 900 will be tomorrow's 1000. Okay. Today's 900 will be. So today 900 is value. It has more. It has an equal value of 1000. So today's 900, it has an equal value of 1000. And today's 1000 will be more than the 1000 only. So if you are writing the exact amount, whatever you are going to get in future, that is undiscounted. But if you are converting into today's value, that is called as discounted. We use interest rate to do this, which we use in a time value of money. It is not that required in the part 1, but if you are understanding the time value of money, it is good. It can help your lease topic. In the topic of lease, it will help you. It will help somehow at least it will help in your part 2. So the time value of money, it will help in your, at least it will help in your part 2, which is nothing but whatever the money I'm going to get in future, I'm converting in today's value. Okay. Suppose consider the interest rate is 10%. Okay. And after 1 year, I'm telling after 1 year, I'll get 1500. Okay. So when you convert into today, it will be lesser than 1500. Agreed? So we'll do division. So we can do 1 divided by 1.1, which is 10%, into 1500 you will get today's value. Okay. Don't need to worry about this right now. In lease or in bonds, we'll discuss this. But discounted, undiscounted term you understood? Undiscounted means whatever future I'm going to get, the same exact amount I'm going to write, not doing anything with the interest rate. But discounted means, which is next valuation method. Okay, discounted means whatever I'm going to get in future, that I'll convert into today's value. Okay. So net realizable value means it will take what? It takes undiscounted amount of cash that it expected to be converted into minus any direct cost required to complete that conversion. Okay, it is used in receivables and inventories. We use this net realizable value. And when it comes to liabilities also, we will write whatever the undiscounted cash expected to be paid. In liability we have to pay, clearing an obligation including any cost to execute the payment. Example, a trade payables, a payable which we have to pay to the supplier, will write in this valuation method. Okay. Next we have discounted value. So as I already told you, so here what we will apply, a time value of money is applied here, where long-term receivables, payables are reported in the present value of future cash flow or outflow discounted to an historical or implicit interest rate, which is nothing but converting a future cash flow into present value is called as discounting. Converting future cash into present value. So if I'm going to get 1000 in future, the present value might be 900 or 950. So which means discount, in the name itself is that discount means do less. 1000 do 950 or 900. That's it. So some assets are written based on discounted value. Usually the bonds is there, right? Bond payments are written, long-term payables are written like this in discounted value. And some bonds we are investing, we invested in bonds, that is asset for us, right? So that is also written in discounted value. So these are the 5 valuation method we have. So one is historical, replacement, current market value, net realizable value, and present value. Clear with this? Any doubts on this valuation? So we'll do this topic and we'll go for a break for accrual basis of accounting, which is easy. So in preparing the financial statement or anything, we use accrual basis of accounting. What is the opposite of this? Any idea? Accrual basis of accounting opposite? It's called as cash basis. In cash basis, if you want to recognize any transaction, cash should be involved. Okay. But in accrual basis, if event is done. Example, I have delivered the product to my customer on December 2025. I have delivered on December 2025. But I have received a cash on January 2026. One, in 2025, what I did, 2025 December, I delivered the product, but in 2026 Jan, I received the cash for this product from the customer. On December 2025, can I record this as a sale? Is account receivable to sales? In accrual basis of accounting, don't worry about the cash. Is event is occurred? Yes, I delivered the product. Event is done. So here I'll record as a sale. Irrespective of the date I'm getting a cash, if the event is occurred or obligations are satisfied, it's a accrual accounting. Like based on that, we'll recognize. So financial statement are prepared under accrual basis of accounting. Okay. How this accrual basis of accounting works? The financial effect of transaction and event and circumstance. You see this word called occur. Once this is occurred, we'll record it. Rather than when the cash is paid or received. Rather than when their associated cash is paid or received, irrespective of the date. We don't worry about when the cash is being paid or when the cash is being paid or received. We'll not worry about this. When the event is occurred, we'll record this. So you should have this. You keep this in mind, because in many places we are going to apply this. We have a topic called revenue recognition, right? The last topic. This is implied there. In the impairment, we use this. In assets also we use this. In current liability, current asset, everywhere we use this accrual basis of accounting. Not only in the income part, we'll take it in the expense part. Example, you used electricity in the month of October, but usually we'll get an invoice when from the BESCOM. We'll get an invoice after 1 month. if I'm using in the month of October to my home, I'll get a bill in the month of November and I'll be paying in the month of December. Okay. When I have to record this expense? Do I have to record this expense in October, November or December? November. I received an invoice in November. But whatever the invoice I received on November, when I have used the electricity? October. I used in October, but I got an invoice in November, but I paid in December, irrespective of the date. When the event occurred, when I have used the electricity? October. So I'll record the expense in the month of October, not in November, not in December. Why? Because the event occurred in the month of October. Suppose I'm not paying in the December, but I created a liability, right? When I have created liability in the October, if I have not used electricity in the month of October, I wouldn't have received the bill. If I wouldn't have received the bill, I wouldn't have paid. So it comes when occur. It occurred in October. So whatever the electricity I use, it comes. So in terms of income and in expense, we use accrual basis of accounting. So revenue are recognized in the period in which they earned, even if the cash will be received in future period. It is called as revenue recognition principle. Based on this principle, we use the word called earned. When you have earned it, correct? It's like I sold the product in the month of December means I earned it in the month of December, irrespective of date when I'm getting the cash. And same way expense also. Expense in the period in which they have incurred. Even if the cash paid in the future, don't worry. Like it's incurred in the October, so I'll tell electricity expense to electricity payable. I'll create a liability. So under the matching principle, expense are recognized in the same periods or related revenue. So this costing is there, right? The costing, because we manufactured 100 chairs, but we sold only 50 chairs. For 100 chairs, I would have already paid labor. I would have already paid materials and everything. But can I tell, because I sold only 50, okay? This one. Okay. Because I sold only how much? 50. I manufactured 100, but I sold only 50. So suppose to manufacture this 100 chairs, I incurred $100,000. Assume that. Can you tell all this $100,000 is an expense? Can I tell all this $100,000 as an expense? Yes. Huh.
You already, paid.
I already paid for 100, but I sold only how much chairs? 50 chairs. So if I sold 50 chairs, irrespective of the cash coming or not, 50 chairs I sold for $100,000. Assume it. I sold for how much? Or I sold for $200,000. I recorded revenue for how much? 200. And how many chairs I am recording here? 50. If I'm recording 50 chairs for the revenue, my expense in the income statement should also be for how many chairs? 50 chairs. So my expense also will be for 50 chairs. So it will be 50,000. So where the remaining 50,000 will go? What it is called as? The unsold chair. What do we call? Inventory. Inventory is what? Asset. So the remaining 50,000 will sit in the balance sheet asset, but 50,000 will go away income statement. So you see the relationship between now 50 will go to the income statement, 50 will go to the balance sheet, and this 50 will go to the income statement when once we are again selling. So that is what this statement says. Expense are recognized in the period in which they incurred, even if the cash will be paid in the future. Okay. Under the matching principle, what does the matching principle says? You should recognize the expense. Where you will report the expense? In the balance sheet or income statement? income. So which means you have to write in the income statement in the same period as the related revenue. Whenever you are writing the revenue, then only you have to write the expenses related to that revenue. If it is not related to that, don't write it. Costing, this is what we learn in section D, when you have to write in income statement, when you have to write in balance sheet, and how much to calculate, that we'll discuss in section D only. But here you have to understand, in the matching principle, what does it say? The related expense should be recognized only there is a related revenue. Because I sold 50 chairs, you can't write for 100 chairs. Okay, tomorrow if I'm selling again 50, then my profit will become entire 50 chairs, right? No, the related cost should be there. So expense recognition principle, associate cost, you see this, cause and effect. Okay, cause and effect relation should be there. Okay, and note says under cash basis, revenue are recognized when the cash is received and expense are recognized when the cash is paid. But under the US GAAP, financial statement cannot be prepared under the cash basis of accounting. We are not going to prepare the financial statement under the cash basis. We are going to prepare the financial statement based on accrual basis of accounting. So understand what is cash basis, but don't apply it anywhere. Clear with this? Before starting the balance sheet, we covered accrual basis, we understood the valuation method, we understood when to recognize, what are the financial statement, elements and users, and the rules. Okay, so we'll start with balance sheet after a break. We'll take a break and we'll start this. So we'll start with balance sheet, statement of financial position, then we'll go to income statement, equity, then cash flow. Okay, so in the balance sheet or the statement of financial position, what does it show? We have to understand here. So a balance sheet shows what the company own and what the company owe. What is the company owned? What does the company have? And what is the company owe to the creditors and suppliers and all those things. And assets and liability presented in proprietary theory. What is this proprietary theory? Is net asset belong to the owners. What is this net asset? Net asset means, any idea what is net asset? We have asset, right? Asset minus liabilities is equal to net asset, or we can tell it as it's a equity. Asset minus liability is equal to net asset or equity. If we say net asset, equity. If we say equity, it's a net asset. Okay. So this is written in proprietary theory, which means net asset belongs to owners. Balance sheet is a permanent account. Why this is called as a permanent account is, we know that ledgers, example, we'll take cash, inventory, account receivable, all these are balance sheet ledgers. So if you take a balance sheet ledger, it will have opening balance, agreed, it will have a debit, credit, it will have an opening balance, and same time cash will have a closing balance, correct? Cash will have an opening balance and closing balance, and next year it starts from where it ended. So that is the reason we call this as permanent account. Which one? A balance sheet is known as permanent account. But when it comes to income statement, we have the income statement, right? Income statement item, example, will tell rent. Rent expense is an income statement item. Does the rent expense will have opening account? No. Does it have a closing account? No. Everything is transferred to a income statement. Income statement items are transferred to, we'll write it as to profit and loss account, or by profit and loss account, we'll write it and we'll close that. Which one? Income statement account. But balance sheet accounts are not like that. It has an opening, it has a closing. It has a story to tell. I ended here and then start from here. Which one? A balance sheet item. So unlike income statement account, they never get closed at the end of the accounting period, or their balance are cumulative and change continuously after year and year. Cumulative means it's keep on adding. Okay, it's called as cumulative. So which account is cumulative? Balance sheet items are cumulative, but income statement items are temporary account. Balance sheet permanent, income statement temporary. So this is what is the formula of asset is in the balance sheet according to the fund theory. Fund theory means who provided the fund? Liabilities plus equities provided the fund. Who gave the fund? So a company, which means I can write like this, the formula: asset is equal to equity. Suppose I started a business, like deposited 50,000 cash in the company's account. What is increasing? Asset increase. And who gave this fund? Owner, which means equity increase. So asset is equal to equity, we can tell. Okay. Now we'll set this aside and we purchased a machine worth of 10,000 by taking a loan. So what is increased? Liability increased and asset is also increased. So asset is 10,000 machine. And what increased now? Liability 10,000 increased. So 60,000 this side. Clear? 60,000 this side. which means an asset is equal to equity plus liability or liabilities plus equity, which is known as this is written in terms of fund theory. Whatever the asset we have, who provided the fund? Our liability is provided this much, equity holder provided this much. Okay. And there is another theory also, proprietary theory. This means asset minus liabilities is equal to equity. What does it mean? It means if from the asset, if you pay off all the liabilities from the asset, if you pay off all the liabilities, whatever the asset remaining is belong to owners. This is proprietary. Is belong to owners. That is. So according to this theory, equity in an enterprise is what remains after economic obligation of enterprise is deducted from economic resource. Economic resource means asset. Economic obligation means liabilities. So from the asset, if we subtract all the liabilities, whatever left out is belong to proprietary, whose owners or equity. So by using the balance sheet, we can evaluate key financial assessment metrics. We can assess all these items. So by using the balance sheet, we can assess the liquidity. What is liquidity means? Liquidity means an asset which can converted into cash is known as liquidity. So by seeing the balance sheet, we can understand how much is their liquid asset, how much is their non-liquid asset. Why do we require to understand this? Because if you are having more asset in a company, it doesn't matter. You should have a liquid asset also. Think your company is having a lot of PPE or inventory or inventory. A lot of inventories have a lot of PPEs you have. But when it comes to liquid asset, suppose if they want to pay a salary next month, can they pay their salary by using the building? No. So they want cash or they want liquid asset, right? They want like current investment or they want cash which we can sell and get the money. But so because to understand this, what like to understand the liquidity, where you will check? You'll check the balance sheet. So who basically suppliers will check the liquidity. Supplier doesn't worry about what is the building you have, what is the land you have. He is worried about how much liquid asset you have. So I want money after a month or after 2 months or after 3 months. What are the raw materials I gave? I want money. So how much cash you are having, how much investments you are having also will check. Current investments, right? Which you can sell in the market soon and then you can get the money back. So that you'll understand. Second one, you'll understand financial flexibility. It gives an ability or it gives a power to overcome the unexpected things and to exploit the opportunities. To grab the opportunities, if you have a financial flexibility in the company, if any unexpected happen, you can overcome that. And if we have any opportunity, you saw any good opportunity you saw, if you have an opportunity, you can invest in that. And you can invest in that opportunity and you can make money. So that is what is financial flexibility says. So when you understand liquidity, you will understand financial flexibility by seeing the balance sheet. So because this in the MCQ they will write these are the benefit provided by the balance sheet except one. So it asks like that. So you have to find the odd one. Next one, solvency. Solvency means an ability to pay its long-term obligation. They took a loan, they have a bond, they have a debentures, right? So it matures after 5 years or after 10 years. So solvency prove that you have ability to pay the long-term obligation. By seeing the solvency, the bank can give loan, more loan. If you are solvent, the bank will give loan again. But if you are insolvent, the bank will not give. And this bond rating agencies, first of all, what they will do, they will downgrade your bond. They will give a lesser CIBIL score to you, kind of. Next, risk. You can understand what is the company's risk. So future transaction, events, circumstance that directly impact company's operational cash flows, you will understand in this. Okay. You understand by seeing the balance sheet. But it has one disadvantage also, valuation boundary. Which one disadvantages and disadvantages the balance sheet have? So information provided in the balance sheet about a company's asset, liability, and equity does not indicate the value of business. What does it say is, by seeing the balance sheet, we can't value the business. Example, suppose company is having a assets. I mean, we'll consider company is having a lot of buildings. In the balance sheet, we have written based on the historical cost method. But sometimes because of real estate, what happened to the building value? It increased than market value. But in the balance sheet, how we have written historical cost method, building we bought for 10 lakh, we are doing depreciation on the building value is 5 lakh. But in the market, the building value is 50 lakh because of real estate reasons. So this is ignored in the balance sheet. So this is one disadvantage. And the value of the business you can't see on the balance sheet. Example, if you watch a show called Shark Tank, in that whenever they come for the valuation, as for the business valuation, they will never say we have this much asset, we have this much liability. They will say we value this much. Example, when it comes to Apple's balance sheet, we'll check. Each shareholder's value is only $6. Each shareholder, based on the company's asset, each shareholder will get how much? $6. But the Apple is trading at $200+. Based on the market, a share price is how much? More than 200. But based on the balance sheet, the share price is how much? Only $5 to $6. That is the valuation boundary that the balance sheet have. Like, because this doesn't show what? A true value of the business. Who doesn't show? Balance sheet doesn't show true value of the business, but it shows what the company owe and what the company own. That's it. But it doesn't show the exact value today it have. Might be the building value is 5 lakh you have written. Might be because of some real estate reason, it may be 50,000 also. But that ignores in the balance sheet. Okay. Now, elements of the balance sheet, we already know elements in the financial statement, 5 elements. In that, 3 elements will be there in the balance sheet. So what are the 3 elements we have in the balance sheet? Asset, liabilities, equity or capital. So we understand the definition now. Assets definition, liability definition and equity definition. So assets are economic benefit that exist in the financial statement date. We told that balance sheet is a permanent account. It ends in one day. It ends on that day and it starts from where it got ended, right? So it shows on that particular day what is your asset value. So an asset is an economic benefit that exists in the financial statement date. On that date, what is the economic benefit you can get from that asset? That it will show. Meaning they have arisen from the past transaction or past event or circumstance. And what it should have? It should have a past transaction. Okay. Or past events or circumstance. Example, if I'm buying a car is asset, there is a transaction, I bought past, and company is telling, we are planning to buy a car next year. Is that asset? No. Why? Because there is no any past transaction is there. Now we'll discuss one more thing. Company is having a goodwill. Goodwill is asset. Agreed. But does goodwill have a past transaction?
It's ongoing, right? It depends upon the company's value.
Brand value. Right. But does that brand value have a past transaction? No, right? So we should not consider goodwill as an asset. Okay. According to US GAAP, you should not consider a goodwill as an asset if it is internally generated. Because according to the definition, what does the definition say? You should have a past transaction. But yes, goodwill will be considered as an asset only if that have a past transaction. Example, I have a company. Okay. Company A purchased company B. Okay. Company B is net asset. Net asset means what? Asset minus liability. That only I have to pay him, right? Because liability, why I have to pay him again? So net asset value is 1 lakh. Net asset value is 1 lakh. But to acquire this company, I'm going and acquiring this company. I paid 1,20,000. I paid how much extra? 20. Asset value of the company's asset value is just 1 lakh. But I paid how much? 20,000 extra. But why do I pay 20,000 extra if the asset value is just 1 lakh? Tomorrow if I sell all the asset, I'll get only 1 lakh. But for that asset, I paid only 120. Why I would have paid? Because that company or that business have some goodwill or have some brand value. For that brand value, I paid how much extra? 20,000. So now all these asset will be my asset. So I'll write asset 1 lakh, whatever the asset purchase, 20,000 I write as goodwill. Why I can write 20,000 as a goodwill? Because it has past transaction. So now you understand why the goodwill is not considered as an asset if it is internally generated. Internally generated means, as you told, ongoing, right? Businesses keep on doing, they are having some brand value. No, it is not considered as an asset. You can consider only as an asset when it has past transaction. Okay, so there is a 3 rules to consider as an asset. One, economic benefit should be there. You're telling I have a car, but it's not giving any value. Tomorrow if you sell the car, no one is going to give anything. They will tell it doesn't even value for the scrap. So it is not your asset. It should, at least it should give some value. If I sell that particular car in a scrap, at least I should get 50,000 or 10,000. Then I can consider that asset value is 10,000. But no one is ready to buy. Everyone, even if the scrap value is 0, means that is not asset. So asset means you should give economic benefit. 2, past transaction should be there. 3, it should be owned by the business. Not legally, in terms of economically. Example, when it comes to lease, we'll discuss this. But we should own it. I mean, we should have the control. Owning means we should have the control. I have a car, but it is not under my control. It is captured by government. Government, and it's under the litigation, and probability is that the government will not give the car back. So it is not your asset. Why? Because it is not under your control now. So 3 rules are there to consider as an asset. You should get economic benefit, arose from a past transaction. 3, it is controlled by the entity. Liability is this. Liability also 3 conditions. 2 conditions are common. It is controlled by the business, which means we are responsible for the liability, and it should also arise from the past transaction. That is common. But here, will you get the economic benefit? Obligation. That's it. It's a liability or obligation where you have to sacrifice the economic benefit. Here you are not getting economic benefit. Here you are sacrificing the economic benefit to others. This also exists at the financial statement date. This also arose from the past transaction. So done with assets and liabilities. Then we have equity. Equity means ownership interest. So this is a residual. Residual means left out asset in a company after paying all the liabilities. So which is equity is equal to asset minus liability. Now this equity is altered by owner activity. This equity can change by what? Owner activity. How this owner activity will change equity? 1, through investment. If he is investing more, what happened to the equity? Equity will change. Or through withdrawal. If he is withdrawing more, what happened to the equity? Equity will decrease. I mean, here if there is an investment, it will increase your equity. If there is a withdrawal, it will decrease your equity. So that is what it says. Drivers of change. Equity is altered by owner's activity. Okay. And also it is altered by non-owner sources. Equity is also changed by non-owners. How the equity will change by non-owners? Because of what? I told you, right, that equity is changed by whom? Because of owners. Because if they invest, increase. If they take fund, it will decrease. But there is a non-owner source. because of that also equity will change. Because of what? Like equity will change because of non-owner. Owner is also there. Owner and non-owner. Owner I told. Non-owner is what? Equity is changing by the non-owners. What it is?
Getting business loan.
Loan. Loan is what? Loan is a liability. It's not equity.
But it is
Invested. But this loan will go to equity or liability? Liability.
But this side also, I mean, like, the money is coming in, right? So it raises the equity, less the liability.
No, see, here is asset. We have equity. We have liability. So now we are discussing about equity. Equity will change because of owners. If we take a liability, will it affect the equity? I mean, consider this as a 3 portion. I took a loan of 50,000. Does it increase my equity? It increased equity and liability. This side 50,000 is increased. I am agreed with that. But my question is, does taking a loan will increase your equity? No. But one activity will increase or decrease the equity. What is it?
Acquiring the other company.
Acquiring the other company. Yeah, acquiring the other company will affect your equity, you say. But when you acquire the other company, what you have to pay? You have to pay asset. So asset is going out and equity is coming in. So at last it is getting tallied. So profit belongs to whom? Profit belongs to owners. If it is owner fund, where it will sit? Whether it will sit in equity or liability, it will sit in equity. So that is non-owners. So non-owner sources means net income or loss or accumulated other comprehensive income, or this AOCI, we call it as AOCI. We'll discuss this accumulated other comprehensive income today, but which means equity is changed by two sources: owner, invest, withdraw; non-owner, profit or loss. Because of this, what it is changing? Your equities are changing. Because in equity, what happens? If from the income statement, what is coming? Profits are coming in. Clear with this? Okay. Done with equity. So you see this investment by owners, it will increase the equity resulting from asset, service or liability conversion, or distribution to owners like dividend, or giving the service, or incurring liabilities to the owners. So investment by the owners or distribution to the owners is the drivers of change in equity from the owner sources. Okay. See, investment by owners means it is not necessary every time they should give the cash. Sometimes some owners will come like this: I will give my time to you. You give the ownership in your company. Example, suppose you started a business, you want an expert. Consider you want a technical officer or someone. You want to appoint him, but he is telling, see, I don't want salary or anything. I want ownership in your company. So what is he is giving his time. So what you have to give? You have to give the equity to him. So what happened here? Its equity is rising. So it's also investment, but it is not a cash, but he is investing his service or time. Okay. Sometimes distribution to owners is not necessary every time should be cash. Sometimes we give stock dividend, property dividend. A company has some property, will give owners as a dividend. We will discuss the different type of dividends, like in the equity 5th topic in your section A. In your section A, first topic is about statements. Then we'll discuss current asset, non-current asset, liabilities. Then we'll discuss the equity, right? Then we'll detailedly discuss this dividends, investments, and all those things. No. Done with the balance sheet. What are the elements is done. Now we'll classify the items in the balance sheet. In the balance sheet, what are the items we have? 3 items: asset, liability, equity. Now first we'll classify asset and liability. We'll classify this into two types. We'll call this as current and non-current. Current asset and non-current asset. So assets and liabilities are divided into current and non-current. Why they are divided into current and non-current is because as the investor, you should understand what is their current asset, what is their non-current asset. So because of this, you will be able to provide the resources to this company or not. Suppose as a supplier, I'm worried about current asset, because by using the current asset only he can settle my current liability. But as a bank, they are worried about non-current asset, more non-current assets. So I can, if he's not giving money, I'll go and capture his plant, property and equipment. Fine. So we have to classify this current. So what is current and what is non-current? First we'll discuss about the current asset. So current asset means this classification start from the time frame. We have some particular time frame where the assets are converted into cash or liabilities are settled. The time frame we take to convert the asset into cash or liability to settle, there we start this classification. Now when it comes to current asset means not only cash, there are other asset which can be realized in cash or used. Sometimes the company itself use it. They are not going to convert it. They are going to use it, or they are able to sell it. Sales and cash is two different things. Not every sales can be converted into cash. Okay. So understand, these three things should happen. Three outcomes should be there. To qualify as a current asset, the resource must be headed from any one outcome. Either you should realize, collect the cash, realize in cash. Either you sell this or you use for yourself. Example of realizing cash is account receivable, you are going and collecting. Account receivable is current asset. Or sell this, sell the inventory. When you sell the inventory, it is not necessary you will get a cash at a time. So we will consider that is also current asset if you are able to do within the time frame. Or use by yourself, prepaid insurance or office supplies. Office have some stationaries, papers or cleaning items, current asset, because the office we are only using. Or we paid insurance 1 year advance, current asset. So if you are able to do this within 1 year or within the operating cycle, whichever is longer. If you are able to do any of this in any one within how many days, or within a year or within an operating cycle, and it says whichever is longer. Now we'll understand this with an example. I have an inventory which I'll be able to sell after 13 months, and my operating cycle is 15 months. Operating cycle is 15 months. First I'll tell you what is this operating cycle. Operating cycle means time taken. It will be different for different industries or different company. A time taken to convert the raw material into cash. A time taken, a purchase of raw material into sales and cash. Do you think all the company will have a same operating cycle? No. Example, a supermarket. He purchased the material today, he'll convert a cash within 1 week. Agreed. But when it comes to a manufacturer who is manufacturing this aircraft manufacturer, he'll take 5 years, or at least he'll take 2 to 3 years. For him, the operating cycle is different. And for a supermarket guy, an operating cycle is different. We'll take any beverage company. They take more time, 5 years, 10 years. A wine Selling companies, they take more time. For a fermentation process only, it takes so much time. So each companies or each industry have different operating cycle. So based on their operating cycle, we'll tell whether it is current or non-current. Now in this example, I'm able to sell something after 13 months, but my operating cycle is how much? 15 months. So can you tell this is a current or non-current? Is it a current asset or non-current asset? Current? Okay. So what is the current asset rule is? Anything if I'm able to sell, consume or realize in cash within 12 months or within 12 months or within the operating cycle, whichever is longer. First we'll apply this condition of longer. Which is longer? 1 year is longer or 15 months is longer? 15 months. So now we have to take what? 15-month condition. And 13 month is fall inside the 15 month, right? It's inside the 15 month. So it is correct. Clear? First we have to apply this condition. Check whether it is 12 months and 15 months. No, operating cycle is 15 and normal rule is how much? 12. And it says whichever is longer, not shorter, whichever is longer. Which is longer? 12 is longer or 15 is longer? 15. Then we have to apply the condition of 15. Bring the 15 and when I'm able to sell this 13th month. So it falls inside the 15. So it is current. Okay. Now we'll take another example and see. I am able to sell after 8 months and my operating cycle is 6 months. Okay. Here in this example, I'm able to sell something after how much? 8 months. But my operating cycle is 6 months. Okay. Now in this, first what we'll do? First we'll see the condition. 6 months is operating cycle, 12 months is a standard condition. Now which one you have to take? 6 months you have to take or 12 months you have to take? 12 months because longer, and this is falling inside the 12 months. So this is correct. But if you take 6 months, assume that you took 6 months, it's falling outside the 6 month, so it will be non-current. But as we have a 12-month rule, this is making this asset as a current asset. Clear with this? How to apply the 12-month rule? Okay. So either it is 12 months or operating cycle, and whichever it is longer. Online, is it clear? Any doubts? Okay. See this example. A commercial aircraft manufacturing facility takes 18 months to purchase a aluminium, build a jet, sell an airline and collect the cash. So their operating cycle is how much? 18 months. Even though 18 months is longer than 12 months, the unfinished aircraft sitting in the, it is considered as current asset. Because we are taking more time, right? Still we consider as current asset. Why? Because we have a condition of 18 months. Even if it is 14 months, 16 months, 17 months, we'll consider it as current asset only. Why? Because we'll take a longer rule condition. Okay. Because it falls within the firm's 18-month cycle, so we consider this as current asset. Clear with this? How to apply the operating cycle and 12-month rule? Okay. Now we'll go through few examples and understand the current asset. So in this, we understood the balance sheet, elements of balance sheet and a boundary. Now we are classifying current and non-current. So we understand the definition of current asset. Now we'll understand few examples in this. First example is cash and cash equivalent. It says what? Cash is a current asset. No doubt in it. It's already in a liquid cash. Cash equivalent is also considered as current asset, and it is also categorized as cash only. We'll tell cash and cash equivalent only. To become anything cash equivalent, we have few rules. First, we'll demonstrate operational cash. Operational cash means a liquid capital day-to-day business you are using include coin, paper, check, money order, bank draft, demand deposit. Everything is considered as cash. Demand deposit means you have a deposit. If you go to a bank and ask, they will give then only. It is not that they will tell you have to wait for 5 years or 10 years. If you are telling that you have to wait for 5 years and 10 years, it is not current. It is not current asset. It is called as restricted cash. It will come in non-current asset. Okay. One is operational, normal cash. Next is cash equivalent. Cash equivalent means it's an investment. So that highly liquid investment we will consider as cash. But there is a rule. The rule is it should be converted into known amount. Suppose I invested in a US Treasury bonds, $1,000. And I know without any decrease in value, I'll get $1,050. I know I'll get how much? 1,050. That knowing should be there, and also it should be highly liquid. If tomorrow I want money, I should have a power to sell it and get the money tomorrow only. Okay, and that can be converted into known amount with negligible risk of value change. Not like a stock you can't consider as a cash equivalent, because we don't know how the stock price will go up and down. We can consider the bond as a cash equivalent. Bond means a known amount it will be. It doesn't fluctuate that much like a stock. And one more rule is it must have a maturity of 3 months or less than the purchase date. From the purchase date to maturity date, it should be only 3 months or less. Example, if I purchase in September, it should get matured in November. That September investment matured means I'll be able to sell and get the cash. Maturity date will tell. Suppose in stocks and all, we don't have a maturity date. Bond will have a maturity date, because bonds are like a paper which is given in exchange of cash, and it's like a FD only, we can tell. Consider it's like a FD. FD will mature on a particular date, right? Like this bond will also mature on a particular date. The investment date to maturity date, it should be 3 months. But this bond I've issued 5 years ago in the market. I mean, example, this bond, you purchased a bond from me when 5 years ago. Okay. And it is getting matured in 3 months. Can you consider that as a cash equivalent?
Yeah. Long-term bond.
Long-term. Like suppose 2020 this bond I have issued. 2025 December it is getting matured. You purchase this on Jan 1st. And when it will get matured? December 31st. Now you are in October. Currently you are in October. Now in October you are preparing your financial statement. According to October 31st, how many months is there to get matured? 2 months. October, November, December. 2 months you will get your money. Can you consider this as cash equivalent? Can you consider this as current asset? Without doubt. Can you tell this is a current asset or non-current asset?
We have placed it in balance sheet, right? I mean, we are recording it as a
Non-current asset. Okay. There is one thing. A non-current asset can be a current asset. No problem. In 2020 it was non-current. 2021, 22, 23, 24 also it will be like 2020, like I think it will get 20, 21, 22, 23, 24. Yeah, it will get matured in 24 because 2020 is also there. Okay. 2024 it will become current. Why? Because on 2020 within 1 year it will get matured. So what is the rule of current asset? Anything which you are able to realize a cash within a year, it's a current asset. So on 2024 January 1st, the same non-current item will become current. Clear? Same like a liabilities also. Non-current liability will become a current liability, which if you are if you want to pay within a year. So same non-current item is big. It's not like one time I have written non-current, it will be non-current. It will become current if a time comes. Okay. So now the question, is that clear? Current. Now question is about the equivalent, cash equivalent. Now I am in October 31st. On October 31st, I am preparing a financial statement. In 2 months, I'll get a cash. In 2 months, I'll get a cash. Can you consider this as a cash equivalent?
Yeah.
Why?
Because it's already
Okay.
current asset, it has a the maturity period is
2 months.
So it falls under cash
Equivalent. But what does this cash equivalent says? You see the bold one, this last line. From the purchase date, it's not about it, it's not telling okay when. From the purchase date till the maturity, it should have only 3 months. When you are purchased, now you are in, like it was already 5 years, so no worry about it. So from the purchase date till the maturity date, how many months it is there? Like 5 years, which is 60 months it is there. So you can't consider that as cash equivalent, but you can consider as a current asset, but you can't consider the item as cash equivalent. Suppose if you want to consider that as a cash equivalent, you should have purchased in September, no, in October. You should have purchased in October in the same year, which is getting matured in the same year within 3 months. So it's not, it's about when you have purchased. To consider that as a cash equivalent, it is about when you have purchased. Clear with this? Okay. So cash equivalent must have a maturity equal or less than 3 months from the purchase date. Example, on July 1st, 2026, a CMA corporation invests excess operational cash into US Treasury bill that matures in September 15, 2026. Can you tell, is this a cash equivalent? When I am investing, July 1st, and when it is maturing, same year. So July, August and August 30, and it is getting matured in September 15. 1 month, 2 month, 2.5 month. July to July 30, 1 month. August to August 30, 2 month. September 1 to September 15, half a month. So it is 2.5 month. So can you consider as cash equivalent? Yes. So the time between the purchase date and the bond final maturity date is 2.5 month. So we can consider this as cash equivalent. Clear with this? So the timeline is 3 months or less than from the maturity days. It is officially classified as cash equivalent on balance sheet. Clear guys? Okay. So now the second item is marketable securities. So marketable securities clearly depend upon management intent, whether to consider it as current or non-current. Why current? Why there is a management intention? If I am telling is, I purchase the investment, and as a management, my intention is to sell within 12 months. So current, and my intention is long term. I want to hold 2 years, 3 years. So then it will become same item, it will become non-current. So it's a equity or debt investment. Equity or debt investment representing temporary deployment of excess operational cash. Suppose if a company is having more cash, what will do? Keeping a cash is a loss because its value is decreasing. So my company will do investment. So to consider this as a current, it depends upon what? A management intention. And suppose if I am investing in any stock, it's a management intention. But if it is a bond, then management intention and a maturity period. Suppose if the bond is getting matured within a year, current, their management intention doesn't play. because within a year, however, I'm getting a cash. It will automatically get matured. Okay. Next, receivable. Receivable is also considered as current asset, because usually within 1 year or within an operating cycle, I'll get my money. Okay. Short-term notes receivable. It is like a promissory note that is given by the short-term, for the short-term credit terms. I gave money or materials. Within a year, I can collect the cash. So it is also current asset. Next, inventories. So when it comes to inventories, we have 3 types of inventory. So we'll discuss this again, but we'll learn right now only what are the 3 types. One, raw material is also inventory. Correct. Suppose if I'm manufacturing furnitures, whatever the raw material I purchase, wood, timber, anything is also inventory. Second, work in progress. Half of the table is manufactured, not complete is done. On 31st December, when my balance sheet is closing, I have 100 tables, which is half manufactured. So that is also inventory. Third one, finished goods. A complete table. Unsold finished goods is also inventory. So all this also comes under current inventories, and it is current asset. Sometimes few inventories will be non-current also. Example, if it is for a contract accounting, it will be a non-current. Example, if I'm doing this contract works will be there, right? Like manufacturing, building and anything, we'll buy few inventories. Few inventories which will not use this year. For next year only we'll buy this year. Example, we'll consider iron. Suppose iron used in the building, right? In construction works, sometimes they'll buy 1 year before only. Because of the price, if it is getting increased, they'll buy before only and they will keep it. But they will not use in this operating cycle to construct. They will use next year. Then the same inventory became non-current. It's about when we are going to use. See, whenever we are discussing any example, anything can become non-current. Marketable security also become non-current. Receivable also become non-current. It's about the definition we learned. What is the definition of a current asset? Anything if I'm able to use, sale and convert into cash within a year or within operating cycle, it is current, like current asset. Next is prepaid expense. Prepaid also can be become current and non-current, but usually it will be current. Prepaid rent or insurance. Okay. Here we are not selling the prepaid insurance. Here we are not cashing the prepaid insurance. Here we are consuming by ourselves. Any one outcome is enough. Consuming by ourselves. So it becomes the current asset. Next, a restricted cash sometimes will become a current asset. How? A cash aside for a specific current purpose. I have a cash kept aside, but I'll use this cash within a year, is also current asset. Why we are not putting this in cash and cash equivalent is because this you should write in a separate line. Because as an investor, when I see this, assume that they have kept $1 million set aside to buy a car. Okay. If you are putting this in the cash, right? No, it will show 1 million is more. But next day you are going and purchasing the car. So your liquidity is, it will fall. It will fall in liquidity. So to present faithfully, we told, to present fairly, because they are taking a decision based on this. So to present fairly, you have to write in a separate line. In the restricted cash, okay, for a current restricted cash, you have to write. And in the notes of the financial statement, you have to mention why it is restricted to for what purpose. But restricted cash will become non-current also. Cash will become non-current also if the restricted cash is for long-term purpose. But here, if it is for a current purpose or a minimum balance fund and all is there, right? Held as a compensating balance. Minimum balance you should keep in your bank account.
Yes.
So that is will also restricted cash. It's restricted. You can't use that money. So that you have to write in a separate line. So these are the few example of current. Then we have non-current asset which do not meet the criteria will be in a non-current. that opposite of current. So here also we have restricted cash, which is restricted from immediate withdrawal or operational use. Example, include cash aside to build a factory or liquidate a long-term loan. We took a loan of $30 million and yearly we are $3 million we are keeping aside. We call that as a sinking fund also. $3 million we are keeping aside to clear the loan after 10 years. So 10 years you will have 30 million, you will clear the loan. So you will not use this 3 million in your business. You are restricting this for the specific long-term purpose. So it became non-current. And marketable investment, just we told, right? This marketable security, same. It depends upon management intention. Stock, bond, long-term note, they do not daily operation. If a stock is highly liquid and can be sold in second, it is classified as non-current. If it intend to hold more than a year. If it has an intention, see, whenever we are going to discuss a current asset, right? In that, we will discuss the investments also. So in that investments, we will discuss, there are 3 types of investments will come. So few investment is current, few investment is non-current. So one will write on one valuation method, one is written on different valuation method. So today we learned a valuation method, we learned about investments. So both we'll put it in a numbers in the next topic. So when you know about the valuation names, when you know why we do this, you just have to put the numbers, that's it. So based on the management intention, if they want to hold more than a year, it is non-current. Next, strategic advances. Strategic advances means a company will give a loan, right, to other company. Okay, and if the time period is more than a year, you can put it in the non-current. Not a loan you have taken, a loan you have given. A loan given is called as asset. So strategic advances which you are given as an asset, if it is takes more than a year to get your money back, current.
Debentures.
Short, you invested in a debentures.
Debentures. As a
Loan. So debentures will put it in the market in this. Where? Marketable securities or marketable investments. Because debenture, what you can do, you can sell the debenture to someone else also. It is not necessary from that company only I should get. Suppose I invested in your company's debenture and you're telling like you will give back money after 5 years and I want money right now. I can sell the debenture to you and you can collect the money from her. Like whenever, or you if you want, you can sell to someone. But this is a loan. A strategic advances means a loan. I gave a loan to you, pay back. Okay. Next is property, plant and equipment. We all know, like a fixed asset. So in fixed asset, we have a separate topic for this valuation, depreciation and everything. So fixed asset is also a non-current asset. Okay, which is giving economic benefit beyond the reporting period. This fixed asset is giving the benefit only, not only for this year. For beyond this reporting period, we'll consider this as a non-current asset. See, at the date of purchase, PP is recorded how? Historical cost. We learned today the valuation method. We will record as historical cost, which means purchase price plus expenditure necessary to bring the asset to the usable condition. Example, if I am purchasing a machine and I paid 1 lakh for that and I spent 5,000 for the freight to bring that machine from another state to my place, and for installation I paid 10,000. Now the PPE value will be 1,15,000. It doesn't mean only we have to write 5 lakh, only purchase price. So the rule of PPE is an asset to bring to its usable condition. What and all money you are spending, everything is asset. Now, we spent on training to use this machine. Is it a asset or it will be an expense? Can we consider that as an asset or can we consider that as an expense? Yes, it's considered as an expense. By asset is in the usable condition. You're using, it's not using, you did a fault. So that is considered an expense. If asset is in a usable condition, so you you spend something, you build something like concrete, you build something to keep that machine. Usable condition, yes, you put in the PPE, then you do the depreciation. But employee training, direct expense, put directly in the income. See, this 1,15,000 will go in the income statement or balance sheet. This 1,15,000 PPE will go in income statement or balance sheet. Balance sheet, because this is asset. Employee training, income statement, because that is not an asset, it's an expense. So if it is a PPE, what you can do? You have a power to do depreciation. But can you do a depreciation for employee training? No. That's it. So that will go directly. This 1,15,000 will go slowly as depreciation. So we call that as capitalization and expense it off. So any expenses you're spending to bring an asset to its usable condition, it's called as capitalization. And anything which is not, expense it off. So the expense it off will go to income statement, capitalization will go to balance sheet. And whatever we capitalized will do depreciation. So that is what asset valuation. We have a topic of non-current, right? Asset valuation, we are doing that. Okay. Next, we'll do what? We'll do depreciation and depletion. Depletion is also depreciation, but used for gas, minerals, and timberland. They are extracted. Like, is land? Do we do a depreciation for the land? No. Why? Because land will not. First of all, the depreciation is done for what? Wear and tear. Because whatever the asset you do, it will wear and tear. It will get damaged. Somehow it will go. But land will never. So land, we never do depreciation. But depletion is done. What is this depletion means? Few lands will have a natural minerals. Example, aluminium. A land is giving an aluminium. So whenever you pay for this land, are you paying only for the land or you are paying for the aluminium value also? Right? If a land square feet is 1,000, assume. But because of aluminium, there is a 2,000. You are paying a same piece of land, you are paying 2,000. So here you are not paying only for the land, you are paying for the aluminium. But we know this, it's not like infinite resource. Whenever we'll tell we have like 100 tons of aluminium. So once the 100 tons of aluminium is over, the land value is go down. So the depletion, what does a depletion do is, whenever you take the aluminium, we have to reduce the value of the land or value of that particular asset. So we'll do that in a physical count method. That means it gives 100 ton. If you have taken a 50 ton, you do a depletion of 50% like that. Okay. Now there is a intangible long-term asset. Intangible long-term asset is also a non-current asset. Example, patents, goodwill, royalties and everything. But we know that internally generated assets are not considered as asset. So it says internally generated intangibles not recorded in the balance sheet, because we learned that it should have some prior transaction. Any cost to develop an intangible internally expensed rather than capitalized. So internally generated intangible is not recorded in the balance sheet. Okay. Like a goodwill, sometimes patent too. Sometimes if you are not spending anything on the patent, no need to record in the balance sheet. But sometimes you have to spend.
A company's employee is filing a patent.
Employee is filing a patent on his name or on the employee's name. Sometimes they will do it.
No, usually the inventor's name, right?
Huh.
I mean the employee's name. But the company will have the agreement that the company will use it.
Huh. Is the company is paying anything to the employee for this?
The bonus remuneration will pay, right?
No, for this particular patent they are paying anything. Like, see, you are an employee, you told, see, I have filed a patent, you want to use, you give me money and you use it. If the employee is telling, you give me money, you give me $1 million and use for 5 years.
Pay, because they have the prosecution and everything. No? Then it will come under.
Then you can record as a asset. Why? We have a prior transaction because you are paying for it. But if you are not paying anything, there is no any prior transaction. If there is no prior transaction, no journal entry. No journal entry, how you can record in the balance sheet? And it should be measured, we told. And it should, if to consider something as an asset, you should have some prior transaction should be there. So then you can consider, if you have a prior transaction, asset. If doesn't have, no. So intangible example is copyright, patent, goodwill, trademark, franchise, leasehold improvements, and right of use of asset. You see this word, right of use of asset. This only we are going to learn in lease. Name itself is a right of use of asset, which means you are getting a rights to use the asset. Then also you consider as intangible. It might be tangible. Suppose you took a car in a lease or a machine in a lease. It is considered as intangible asset. Okay. When you tell, see, car, it's tangible, but nature of asset is look like an intangible because it has a prior transaction. You have a control, but you don't have an ownership in the lease. You can't sell that car because you are not the owner of the car. But can you use the car? Yes, you can use the car. Because of that, you have a power to do amortization. And PPE, fixed asset, what will do? Depreciation will do. Intangible assets are done amortization. Intangible assets are fixed asset, depreciation, intangible asset, amortization. Same, only name is different. Okay, clear with the current and non-current assets? Now we have a current liabilities. Current liabilities means a legal obligation. It's a legal obligation or debt that a company reasonably expect to settle through one of the two method or two pathway. If a company expect to settle this with any of these two method, it is considered as current liability. One method is by using the current asset. If you are using the current asset to pay the liability, it is current liability. They are not telling only cash. Anyway, you use your current asset to pay the current liability. Use your asset to pay the liability, it is considered as current liability. Here, don't think about the time frame, 1 year or nothing. Usually it is 12 months. Then only the asset will become current asset. Here also it is applying 12 months and operating cycle rule is there. But they are not telling directly. This liability is connected with asset. If you use this asset to pay this liability, this became a current liability. Which means here also the same rule is applied. It also has a definition. If you are settling any liability within 12 months or within the operating cycle, it is current liability. But here they are putting in a different way. Because to become a current asset, that rule is there. If you are using this asset to clear this liability, it became a current liability. One is this method. Other method, by creating another current liability, such as replacing a trade account with the short-term promissory note. One method is what? By giving the current asset. If you are settling, it is a current liability. Or you are converting this current liability with another current liability. Example, I want to pay a person within 12 months. Okay, I didn't use my current asset to pay, but I used another loan. I took another loan which I have to pay within a 12 months to pay this. So what becomes this new loan? This loan will become my current liability. Once settled, this will go and this loan will become my current liability. Okay, either I have to use my current asset or either I have to create a new current liability to clear this liability. Okay, So examples of current liability include trade obligation like accounts payable, short-term trade payable, issued to supplier for regular purchase of inventory, goods or see whenever we purchase the inventory from the supplier, it creates a liability, right? Suppose if you are not paying, that is called as trade obligation. It is also current liability. Next, returns and prepayments, declared returns and prepayments, like a cash dividend declared but not yet paid, or contract liability, unearned revenue. Example, customer gave a cash of 50,000. Customer gave cash of 50,000 in the month of November 2026. Okay. But you have not delivered the product yet. Can you consider this as your income? Put the accrual accounting. Imagine the accrual accounting, whatever we learned. Customer gave 50,000, but we have not delivered the product yet. Okay. Can we consider this 50,000 as an income? Rendered. Service is not rendered, event is not yet occurred, obligation is not yet satisfied. So this is not income, this is liability. So what will be the double entry? Cash to liability. Asset increase, liability increase, balance sheet tally. Okay. So it created what? It created a liability. So that is what contract liability. Unearned revenue. We can tell it as unearned revenue. But you can't put this amount in the income statement. Okay. You have to put only revenue, not unearned revenue. So customer prepayment or goods or service yet to be delivered, yet to be rendered, yet to be delivered. Okay. And declared returns means cash dividend declared. We called all the investors and told we'll give the dividend. We declared it. We'll give the dividend. Every shareholder will get one dividend, $1 dividend. That also become a current liability. Only what dividend? Cash dividend. Okay. Cash dividend. Okay. It will become a current liability. Next, fiduciary or demand debts. Security deposit received from customer, agency collection, GST and all. These restaurants and all, if you go to restaurant, they will collect the GST from us, right? So GST doesn't belong to them, it belongs to government. So all this will become a current liability. Okay. Sales tax or payroll employee tax. Sometimes from the employees they will hold the tax. Okay. So that one doesn't belong to them. They have to pay to the government on behalf of employee. Okay. Next, portion of long-term debt. I told, right? A few non-current item will become current. Example, in 2022, you took a loan which matures in 3 years. Okay. 22 it was non. 23 also it was non. But in 24 it will become current. Why? Because you have to pay within a year. It was a non-current. Now it became a current because time period is time frame. Next, loan covenant breach rule. What is this loan covenant breach rule is? Banks will give a rule to this company. Example, you took a loan of $10 million from the bank for 10 years. $10 million for 10 years. It was a non-current. But the bank told you should maintain this much liquidity in your balance sheet. Or you should maintain this much asset as a liquid asset. Some rules they will give that you have to follow. But if you are not following, the $10 million which was due for 10 years will become right now. If you are breaching the rule, whatever the rule is, if you are breaching the covenant, we call it as a rule or a covenant, liability will become current. So then it is a current liability. It's callable on demand. Then it become a current liability. Next, accruals and warranties. Accruals means what? Accruals means an expense incurred but not yet paid. The electricity example I told, right? Electricity is used in October. So October it will become accrual. It become my liability. Or employee salary due, wages, outstanding wages. All this become accruals. Warranties will also become current and non-current too. Warranty means whenever you buy a phone or any electronic item, you'll get a warranty. What is a warranty? Gives the power to a customer. Whenever if any problem falls or anything is there, you go back to the company, they will do it for freely. They will not ask any money. So they have a liability. They do have a liability, right? So what's the definition of a liability? Sacrifice of economic benefit. So your company has to sacrifice some benefit, like your company is giving your employee time or some material they will use to repair it. Some economic benefit is giving to others and they are not collecting any cash from you. So it is a liability. And if the warranty is expiring in the next period, it's current. If it is not expiring in the next period, it became non-current. That's it. See, any current, non-current, that time period, if you know, it's done. Now, current liability does not include these two things. Debts to be paid by fund in account classified as non-current. When it will become current? A liability will become a current when you are using current asset. But if you are using a non-current asset to pay this debt, it is non-current. It is not current. And a portion of short-term obligation. Okay, a portion of short-term obligation intended to refinance by a long-term obligation subject to fulfilling requirement as noted below. You have a current liability which you have to pay within 12 months. Current. But you have an intention to classify this current liability into non-current liability. Assume that I want to give a money to you within 12 months. I want to give money to you within 12 months. But I have an intention to convert this 12 months into next 2 years. One intention is there, but only intention doesn't enough. You should also agree. The other party should agree. So we call that as an ability. So if you have an intention and ability, and if you are able to refinance this short-term obligation into long-term obligation, then don't include in the current. You have intention but no ability means you can't. You have ability but no intention means you can't. You should have intention and ability. Intent and ability to refinance an obligation that in coming due in the next 12 months, if you are able to reclassify, then you can tell it as non-current liability. For example, when a company show that is an intent and ability to refinance an obligation that is due in 9 months, the company can show the obligation on the balance sheet as non-current, because management know it will use the fund received from the future long-term finance to settle the existing debt. So the company is replacing one debt to another debt. Example, I took a loan from you which I have to pay within 12 months. I have to pay within 9 months. But I know and I have an ability and I have an intention to get a loan from here for next 3 years, and I'll be able to pay from that money to you, then I no need to write your loan as current. I can write it as a non-current. Why? Because I'll get a money from here and I'll settle it. Because I'm not using my current fund, right? If I'm using my current fund, it's current liability. But I'm using some non-current liability to settle the current liability. So it is non-current liability. Clear? Okay. Now we have bank overdraft. Bank overdraft is a liability or asset? Because we have to, they are giving a power or like an option to withdraw money more than my balance in the account, which I have to pay back. It's like a credit card or a bank overdraft, but we have to pay the interest also. Here we have a different rule in accounting for bank overdraft is, suppose I have a bank account in SBI. Consider I have a bank account in SBI, but I have 2 bank accounts. Okay. In one account, it's minus 10,000 overdraft. In one account, 40,000 plus. In one account, 40,000 in plus, and one I have taken overdraft. In the balance sheet, how I have to write is a question. So in the balance sheet, you can net off and write. In the balance sheet, I can write my asset as 30,000. Okay. No need to write 10,000 overdraft and 40,000 in the bank. But If it is a different bank, you can't net off. In SBI minus 10, in HDFC you have plus 50. Then in asset you write plus 50. And in SBI, in liability you write minus 10. So rule for a different bank. So you cannot be hidden and subtract from the cash. And you have to write as a current liability. Transparently you have to write. But if it is the same bank, you do net. Current cash item, you do net. Like I did for a plus 10 and plus 40 and minus 10, right? And I've written plus 30. Like that only you can write. If it is a same bank account. Okay. Clear. Current liability is done. Next we'll do on non-current liabilities. What is this non-current liabilities? Anything which is not current, it comes under non-current liability. Which is not settled or liquidated within 1 year or within an operating cycle. It's a non-current liability. Example, long-term loan or bond payable, which is more than a year, or non-current liabilities, unearned revenue. See, here also there is unearned revenue. Here also there is unearned revenue. Here also there was unearned revenue. Here also there is unearned revenue. Unearned revenue means what? Where you have received the cash from the customer which you have not yet rendered the service. If you are able to render the service within 12 months, current liability. If you schedule this service or a product you will deliver after 1 year, it become non-current liability. It's about when you are using your current asset. It's not current asset doesn't mean only cash. Either I'm using my inventory to settle this. Suppose you want to purchase furniture from me and you gave me an advance telling that you will come back after 2 years and get the furnitures. So when you will come back? After 2 years. Am I using my current asset right now? No. But I'm using my current asset after 2 years. So it became a non-current liability. Next, non-current warranty obligation. Same guys. Warranty there was current, here it is non-current. If a warranty is more than a year, then it will become non-current. Next is net deferred tax liabilities. What it is? Net deferred tax liability. So it's a future tax obligation arise from temporary timing difference. You see this deferred tax, we have a separate topic for the deferred tax. But consider deferred tax, there will be a liability, deferred tax, there will be an asset time being. Okay. Under US GAAP, they are strictly non-current. Which one? Deferred tax liabilities are non-current. See, this deferred tax liability means a tax which is postponed is called as deferred tax. If it is a liability, if a tax liability means which I have to pay, which means I have postponed it. A deferred tax asset means which I've already paid prior. Now I no need to pay, I just need to claim it. So then it will become deferred tax asset. So we have a separate topic for deferred tax, which I get a feedback from a student is this is more confusing. It's easy, but it's confusing, bit tricky. Which one? Deferred tax topic is a little bit trickier. Deferred tax, lease, warranty, these and all, it's trickier. When it comes to asset side, it is easy to learn, to apply. Liabilities are also easy, but trickier part. This lease is also tricky. This deferred tax is more tricky when it is asset, when it is liability. So we'll keep two statements, tax statement, finance statement. We'll understand that. But for time being, now understand deferred tax liabilities is a non-current liability. Okay. So done with current asset classified in the balance sheet. If you take, we're done with asset, we're done with liability. Now we are left out with only equity. Any doubts still here on asset, liabilities, balance sheet? Clear? Clear with this? Okay. Online guys, clear? Sweta, Humera, clear with this? Now what is left out? Equity is left out. Okay. You know the formula of equity now. Equity is equal to asset minus liability. So equity means a residual ownership in a business enterprises. It is exact portion company asset owned by the owners. Company asset is there, right? All the asset doesn't owned by the owners. if 1 lakh is asset, 40,000 is liability, and 60,000 is equity. So in 1 lakh, the asset owned by the owners is known as equity. So in 1 lakh asset, 60,000 is whose asset? Owner's asset. 40,000 is whose? It's creditors, it's outsiders, it's not owners. So that is called as equity. If a corporation were to completely liquidate, equity represents the net money amount which theoretically will be distributed to owners. Suppose if I close the company now, what I'll do? I'll sell all the asset and I'll get 1 lakh. Then what first I have to do? I have to pay the liabilities first, because not the owner first. First who will come? A liability, because liability is a legal responsibility to pay. That is what the benefit the liability holders get. So I have an option to invest in your company in two ways. Either I'll come as a debtor, either I'll give a loan to you, or I'll take a equity from you. If I take equity, what is the benefit for me? I'll get a ownership. But if I take if I give a loan, what is the benefit for me? I'll not get the ownership, but I don't need to worry about my money. If you close the business, if you bankrupt, whatever the asset is there, first you have to pay me. Then only you can take your assets. So because of this, I'll get a power of what priority in the asset. Priority in liquidation of asset is given to liability, bond holders or debenture holders. So this equity means theoretically, if my assets are sold and pay all my liabilities, whatever the left out belongs to equity holders. We already discussed this part, right? Equity is a dynamic element. It increase and decrease based on two pathway. What are the two pathway we have? Non-owner and owner source. Non-owner source means not dividends. Owner source means dividends and investments. Non-owner source means income, net profit, loss, gains and loss. So increased by net income or other comprehensive income, or reduced by loss or other comprehensive loss, is non-owner. Dividend is given to whom? Owners. So it becomes owner source. Investment is done by whom? Owner source. Investment withdrawal is done by whom? Owners. So it's owner. So increase in direct investment made by the owners or reduced by distribution, like a dividends or a treasury stock, is known as owner sources. So equity is a dynamic element. Equity will be keep on changing. It increase and decrease by two different pathway. One is owner source and one is non-owner source. Clear? Okay. You can write this one which is in bold. Equity is a dynamic element in two distinct pathways, non-owner source and owner source. Non-owner source, income and losses. Owner source is investments and withdrawals. Dividends?
Rendering services.
To whom rendering services?
To the company. They don't want to invest, but they render service.
Okay, owners rendered services. So it will be owner sources, but it will go to equity, capital. Sometimes they will give money, sometimes they will give services. See, anything which is connected to owners, right, or anything connected to equity because of the owners is owner source. Anything which is we are earning income or expenses will come non-owner sources because of the performance. Okay. owner's equity for corporation is split into 6 different categories. The asset liabilities we classified into two: current, non-current, current, non-current. But in the owner's equity, right, in the balance sheet, asset done, liability done. Now we'll go to equity. Equity, we can see 6 different categories, but it is not necessary all the companies should have 6 different categories. So first category is capital stock. A par value or stated value of share officially issued by the corporation. It will have capital stock. Second one, it will have additional paid in capital, which is a premium or excess amount contributed by the investors above the par value when shares are sold. We'll understand this with an example. So example, company issued 1,000 shares for $20 and par value of the share is $2. Okay, what is the capital stock or common stock? We can tell it as a common stock or capital stock, and how much amount will go to the capital stock and how much amount will go to the additional paid in capital. These are the two categories: common stock and additional paid in capital. So how much it will go? First, each share is issued for how much? 20. Suppose we are issued and we received cash. So what entry will come? Cash will come. Cash will come, right? On each share, how much they are giving cash? On each share they are giving 20. 1,000 shares are issued. Everyone purchased. No debate. Everyone purchased. Everyone gave money. So I'll get how much? 20,000. Now this is done. This will be there on the asset side. In the meantime, I'll write here. I'll draw the balance sheet here. Here asset, how much cash I got? 20,000. Now this side also should equal, right? Now 20,000 I received. Two things is there here: capital stock or common stock and additional paid in capital. What is the par value of the share? 2. How much they pay additionally? $18 they paid. It was a 2. The paper value of the stock was 2, but they paid 18 more. They paid 20, which means they paid 18 more. So 18,000 will come here and the par value will come here. So it will debit equal to credit. So now if I take to the balance sheet, equity side, what and all 6 category I have. One is common share or capital stock, additional paid in capital. 18 plus 2, 20. So my balance sheet got 10. Clear with this? Okay. We all know that how this elements work, right? What are the 5 elements we have? Asset, liabilities, capital, expense, income. Increase, decrease. Okay. We all know this journal entry, but I'm making sure you understand this. If asset increasing, debit or credit?
Debit.
If asset decrease, credit. Liability increase,
Debit. Credit.
liability increase, credit. Liability decrease, debit. It works in opposite way. Capital, which equity or capital, same, credit, debit. See, asset right side we have in the balance sheet, so it increase debit, it decrease credit, and liabilities is liability and equity both are on the same side, so they work on their debit and credit is same. If it increase credit, decrease debit. Okay, clear. Now income, will come to the income. If income increase, what will increase? Suppose income increase means profit increase. So profit increase, what increase? Equity increase. So income will also work like a equity only. Income will also work like a equity. So equity increase, credit. So income will also work like that only, right? So income increase, credit, and income decrease, debit. And the expense, it works like an asset, because whenever there is an expense, you have to give what? You have to give your asset. So whenever you give your asset, what is decreasing? Asset is decreasing. Because of what is increasing? Expense. So it works like this. So it is this two in one way, this three in one way. I mean, asset and expense is same. Liability, equity, and income, it's same. Okay. So this is a journal entry, a simple journal entry method, but sometimes if they are asking, okay, you put it, but moreover here it's not about journal entry, here about increase, decrease. What is increase, what is decrease? Based on that, you should increase and decrease in the balance sheet and check your balance sheet getting tallied or not. See, each transaction example like you, I'll create balance sheet and check how it is getting tallied or not. So it's about increase and decrease, but I just want, if you know this, it's good. You should know this, because as a CMA student, we have to know this, how the debit entry and credit entry works. Either we are not using or using, but yeah, somehow we will use this. If you're not getting in MCQ also, this you will be using in your costing something, because if you understand the debit and credit entries, you're sorted. You know how the income statement and balance sheet works. So we were discussing about this part. This additional paid in capital and capital stock. Okay. So cash, asset increase, debit, equity increase, credit. APIC is also whose item? Equity item. So you should understand whose item it is. Rent, expense item. APIC, whose item? Equity item. And common stock, equity item. Cash, asset item. Machine, asset item. Loan, liability item. So these items you should understand, and how this item work you should understand. Okay. Now, is it clear with common stock and additional paid in capital? If I'm telling additional paid in capital means a shareholders contributed by investor above the par value is known as additional paid in capital. Next, third one is retained earnings. In the name itself is there. Retained earnings. Retained means set aside or we kept in the business. Okay. Earnings means income. Income means who? Your profit. So the cumulative net income of a business that is being reinvested and not distributed to the owners as dividend. So retained earning means profit which is not distributed to owners. So profit means, so it is a cumulative one. Retained earning is a balance sheet, so it's a permanent account. So cumulative means where it's closed, it start from there. Okay, and we add this year profit and close it. So retained earnings, how it will be is, so we have opening retained earnings. We add what? We add profit, because the cumulative of profit. We have a profit, we'll keep the profit here. Then we'll have closing retained earnings. Okay, one more item will come, but I'll tell when what to do. So now you understood. I have a retained. 10 years I was doing business. Till 10 year, which is not distributed to owners, I made 10 lakh as a profit. Each year 1 lakh, now I have 10 lakh. 11th year I made 1 lakh. So 10 lakh plus 1 lakh. Now this year I'll close with retained earning as 11 lakh. 10 plus 1, 11. So that is what your retained earning is. Clear? Three things. AOCI, it is not necessary every company should have. Sometime it will have, sometime it will not have. It says accumulated other comprehensive income. What is this accumulated other comprehensive income? Income where you will report usually? Income statement. But this one is telling to report in the balance sheet. Because all the 6 categories, the equity category. Equity belongs to balance sheet. But this says accumulated other comprehensive income report in the balance sheet. But we were doing what? We were reporting the income in the income statement, not in the balance sheet. But this means this OCI, other comprehensive income, is different from the normal income. What does this OCI means? An income which is not yet realized. Simple words. Income which is not yet realized. The income which is not realized. You earned, but you not realized. You can't tell you earned it, but you earned. Example, a simple example. We have a separate topic when it comes to income, but I'll put it here in a simple example. You invested in a stock. Stock value increased. You invested for 100 rupees. Today the value is 110, but you haven't sold it. Okay. If you're selling today, you will get 110, but you haven't sold it yet. Now you're writing your balance sheet. You're closing the book. Will you write 100 or 110? You purchase for 100. Now the value is 110. Now you're closing the book. Now on the balance sheet date, you will write for 100 or 110. So we'll write this in the current value method. Current. Okay, market value. Because market, based on this, my value in the asset will be how much? 110. So if I take the balance sheet, see, I'll take the balance sheet. Now it was 100 here. Now it got increased by how much? 10 increased. If 10 this side is increasing, this side also should increase, right? In the asset side, how much is increased? 10. Only see what, don't worry about 100, it's already there. Now we'll see how much increased. How much increased? 10 increased. Okay, asset is increased. Then this side, liability and equity side should increase. Is it increased by the equity? Sorry, is it increased by the liability? No, it is not. We have not taken any loan. But this $10 is increased. So some profit should get affected. But we will not report this in the income. Why we will not report this in the income is because you haven't realized it yet. Have you sold and got the money? No. Have you sold? No. If assume that you recognized it. Tomorrow, what if the share price is going down? Have anyone promised you that you will get 110 whenever you sell? No. Tomorrow it may go 90. Tomorrow it may go to 50 also. Because of this uncertainty, right? We'll report this in other comprehensive income. There are not only this investment, there are many items are there. We put 5 to 6 items are there, which will be other comprehensive income. So those items will come directly in the equity part. But this $10 belongs to whom? Owners. So we'll put in the equity. But this will not go to income statement and balance sheet. This will go to income statement when you realize, when the sales is done and you got that 110, then you put no problem. Until and unless you're not selling and realizing that investment, you can't put that under the income. Then you remove, what you will do whenever you realize, you remove from OCI, you will put in income statement. So OCI will go down, income will go up, and again it will come to retained earnings and UCL. So the effect minus, plus, again plus. So here you have an addition in the retained earnings. So that is AOCI. So fourth item, clear? There is a detailed discussion on AOCI. Examples we are going to, one example is current investment. And fifth one is treasury stock. What is this treasury stock is? Whenever owners are investing, what happened? Company will get cash, equity will go up. What the company did? The company did, so company had 10 shareholders. I called 2 of them and told I'll give the cash. You give up your ownership. You're not owners from going forward. So what happened when I give a cash? That will go down. Is the liabilities going down? They are not liabilities. So what will go down? Equity will go down. So treasury stock is a contra equity. Contra equity means a reduction in equity. Treasury stock is a reduction in equity. What you are doing with this? You are giving a cash to them to go. So they are not owners. So the ownership will go down. Same time, assets also going down because I'm paying cash them, right? So balance sheet tally. So treasury stock is a contra equity account representing the company own share that it has repurchased from the open market. So it holds a debit balance, so it reduces the total owner's equity. What is this debit balance means? Equity is in the credit balance. Whenever equity increase, what you have to do? Credit. Equity increase, credit. But this one will be in a debit. Why? Because this will not increase, this will decrease your equity. So it has an opposite. Whenever we tell treasury stock increase means equity decrease. Okay, so that is treasury stock. And the last one is non-controlling interest. This also it's not necessary. The fourth, fifth and sixth item, it is not necessary every company should have. Okay, 1, 2, 3 will be there. Fourth, fifth and sixth is not necessary. Every income statement every company should have, but might be. What is this non-controlling interest is? Company A, company B. Now I have acquired a company B. Company A is going and purchasing the company B. Now company B belongs to whom? A. So whatever their asset is my asset. Whatever their liability is my liability. But whatever their equity will be not my equity. Their equity I told them to go. Whatever I told, see, they told you pay me $120,000, you take my company. Now will they be a owner in my company? No, they are not owners. So there will be no equity. This will be when 100% if I acquire. If I acquire your company 100%, no equity will come. But if I'm acquiring only more than 50 should be there, okay? Because below 50 I will be not owner. To be a owner in your company, I should hold more than 50%. Then I have majority. So when it's more than 50%, there is a rule that the company financial statement should be consolidated. Consolidation will tell, which means the company B's balance sheet should consolidate with A. Okay. So whenever I consolidate, but I'll take all their assets. I'll take all their liabilities. But in equity, do I hold 100%? I hold only 70. So rest 30 belongs to whom? Someone else. So that 30% you will show here in your equity. So this is called as non-controlling interest. You took their all asset, right? You took their all liability, right? But you're not owner of all the asset. You're not owner of all the liability. So in this 30% belongs to whom? Non-controlling interest. So that is what we have a topic of consolidation. We'll prepare the balance sheet and see that. But these are the 6 category you should understand. So by understanding these 6 category, see in this each category we are going in detail. That's for sure. In equity, not only this classification, everything will go in detail. But basically all the 6 category will go with capital stock, will go with APIC. That too, it's together. Retained earnings will go, and AOCI will, whenever we are discussing the income, we'll discuss that. Other comprehensive income. Treasury stock, we have a topic. Non-controlling interest, whenever we discuss the consolidation, we'll discuss. But understand all the 6 categories is there, so we can understand the statement of changes in equity. 4 financial statement we have, right? We are covering right now balance sheet. And third financial statement is statement of changes in equity. If you know this portion, statement of changes in equity topic is done. Okay, clear with the 6 categories? Common stock, additional paid in capital, and one more category also might come, which is preference stock. If they have preference stock, it will come. There are 2 types of stock: common stock, preference stock. Common stock is a core owners who have the voting rights. Preference stock don't have voting rights, but they have a preference in the liquidation and they have preference in the dividend. If a company is giving a dividend, right, first to whom they have to pay the dividend? Preference shareholders. And if a company is closing, first they will pay the liability, then they have to pay to the name itself says. Okay, so if it is there, that will be also there under the equity part, not on the liability, right? It will be in the equity portion only. Okay, clear with this 6 categories. Now we'll see the transaction analysis, which says an accounting equation we have to put. Easy, nothing. Suppose borrowing a cash from a bank with note payable. When I borrow cash, what is increasing? Asset increase, which is cash increase, and what is increasing? Liability increase. No double entry, no debit credit. This balance sheet format you should keep in mind. That's it. Now, receiving a cash when providing service for customer. Receiving a cash. See, I make it easy for me when I'll put cash in first. Whenever I put cash, it is easy. So what is I'm getting cash? So asset increase. Service from the customer. See, whenever I give a service means I'm earning what? Like my company's job is to provide cleaning services. I'm not selling any product. I'm giving a cleaning services. So customer came, I gave the cleaning services. What it is? What it is for me? I earned in money. It is called as income. Income increase what? I mean a profit. So profit increase, I will come step by step. I earned this, so income increased my profit increased my equity, so that is stockholders equity. Service. See, asset, liability, equity, only these three things, that's it. Paying a supplier an amount owed on account. We owe money to the supplier, we paid. What is decreasing? Cash decreasing. And what is decreasing again? Liability, because I have to pay to someone, right? When I paid, my obligation reduced, my responsibilities are done. Okay. Purchasing a inventory on account from supplier. See, on account means on a liability, not on a cash. So inventory I purchase. What is increasing? Asset. Inventory is increasing. I purchased timber. So my asset increased, my raw material increased. But same time, what is increasing? Liabilities, because I need to pay him. Future sacrifice to be made. Okay. Purchasing an equipment with cash. What is increasing? Equipment is increasing. Cash is reducing. No effect in liability and equity. Only asset side. Okay. Clear with this? Oh, suppose one more. If I want to put electricity used in the month of October, what will be the double entry? Asset, liability, equity. What is increasing here? See, am I getting any asset if I use the electricity? No. But what is increasing? I have not paid the bill yet. So if I'm not paying the bill yet, what increased? Liability increased. And what is doing? It is reducing my electricity is what? Expense. Expense increase, what will reduce? Profit. Profit reduce, and the profit will reduce my equity. See, here 100 increase, here 100 decrease. Ultimately it is no effect on the asset side. So balance sheet is already tally. Okay. Same. Salary payable. The salary is what? Expense. Equity reduce. Payable not yet paid. Liability reduced. Salary paid. Liability reduced. Cash reduced. So tally. Like that, any transaction you take, asset, liability, equity. Put this in the format. Done. We'll put like this. Prepaid insurance. I paid a insurance for a 12 months. 12,000 rupees. Monthly 1,000, 12,000. So what is going out? Cash reduced. Any liability effect? Any liability increased? No. Any equity increased? Equity increased or decreased? Expense, see, insurance I paid. Is it insurance I paid in advance? Is it an expense right now? No. So no increase here. But what is increased? Prepaid expense, asset increased. So one asset decrease, one asset increase. So whenever, now 12 months is over. 12 months is over, insurance period is over. Now what happened here? You had an asset called prepaid insurance. Do you have right now? No, because you already used. Asset reduced. Any effect on liability? No. 12 months what you have used? You have used this insurance. So which means expense increased. Okay. So expense increase, equity reduces. So all this like accumulative effect. Example, if you take a landlord, I paid landlord $24,000 of rent on Jan 1st. I'll record how prepaid rent asset increase 24,000, cash asset decrease 24,000. Now what happened? Like 12 months is done. When 12 months is done, I got the service from the landlord, which means it's a expense. I got a service, means they gave some service for me, which is called as an expense. See, in accrual accounting, it's an event. It's not about the cash. Is they have provided the event, is they have satisfied their obligation to me? Yes, they have done. So rent expense, which is expense increase, debit 24th. Now, will you pay cash again to him? No. So you have an asset, right? Prepaid rent. That asset will go down 24th. Clear with this? This is how the double entry works. Done this. Okay. And this is how the balance sheet look like. This is the Apple's balance sheet from their website. Okay. This is the balance sheet for 2025 September. I mean, in US, in India, we follow what? April to March, right? In US, your company can follow any 12 months period in to present your balance sheet. Okay. But within 30 to 90 days, you have to prepare it. I mean, September's balance sheet, I think by December, they have to prepare and present. If your company closing the books on 31st December, it is not possible to close and prepare in the same day. So the SEC, in India we have SEBI, right? Security Exchange Board. In US they have SEC, Security Exchange Commission. They want the company to present their statement within 30 to 90 days based on the size. Each based on their size, they have to present. Like that Apple's balance sheet, whatever we learned, it's exactly same way. You see the Apple balance sheet, their current assets. We learned the current asset, we learned the non-current asset, but it is in millions, okay? Now, their current asset plus non-current asset makes what? Total assets. Okay. Now, they will come to their current liability, and non-current liability will make their total liabilities. And this will come to their equity part. So total shareholders equity. So A plus B, which is liability plus equity, is 359 241. And we know that asset will be equal to liability plus equity, 359 241. See each item we have. See, we learned about cash and cash equivalent, marketable securities, account receivable, vendor non-trade receivable. Might be not because of the sales, might be because of non-trade, inventory and other current asset. You see their non-current asset is more than the current asset. Like this, we'll analyze in part 2, section A. There is a financial statement analysis. There we'll analyze how much is the liquidity they have, what is the ratios they have, and all we'll learn in part 2. Here we are learning to prepare. Here we are not an analytic person. Here we are a financial accounting person, a person who know how to prepare the financial accounting and the rules of the financial accounting. See, there marketable. See, here also there is a marketable security. Here also there is a marketable security. Exactly the way we learned. Okay, and now we'll come to the shareholder equity. Common stock, additional paid in capital, everything they have given in one line, 93,568, and accumulated deficit and accumulated other comprehensive loss. They are not having an income. They are having a loss in accumulation. They are making a loss. They are not in the profit. Okay, and this is total liabilities and shareholders equity. We have a continuation of income statement. When we start income statement, you will see this. Okay, so clear with this, and we see non-current liability, current liability, commercial paper temp, Commercial paper and all is a loan you get for a short-term purpose. That's why it sits on the current liability. Okay. That's it with the balance sheet. And see, benefits and limitations of balance sheet. Once done, we'll jump into income statement. See, what are the benefits of balance sheet? We'll see. We'll understand this because sometimes they will ask the benefit of balance sheet and give the options of income statement. So we think that we learned this, but we should be sure where we learned this. IMA will confuse you. They will not give anything out of the textbook. They will give from the same textbook, from the same sections only. They will ask for the balance sheet and give the option for income statement. You will think, yeah, this one we learned in the section A, but not in this topic. So in the balance sheet benefits, we learn to rate of return. Balance sheet helps to compute the rate of return, how much return we made. Okay. And evaluate capital structure. What is this capital structure? Means asset is called as capital. I mean, we call equity as capital mostly, but asset is called as capital. Capital is what? Something which makes a run business, right? So how this capital structured is known as capital structure. How this capital is structured? By liability and equity. From where you will understand this? By looking into the balance sheet. And predict the company's cash flow. Where you will see the cash? In the balance sheet you will see the cash. It helps to assess the risk, liquidity, solvency, financial flexibility. In the starting only we learned this, right? That's it. And limitations, there are a lot of limitations you have. One is not all the assets are reported in the balance sheet. One example is internally generated assets. It is not reported on the balance sheet, but it is giving you the economic benefit. The brand value is giving something to you, but you're not reporting it because of the rules. That is what a limitation of balance sheet. And the balance sheet doesn't show a true value of your business. I told the market price and market price, whatever we have. You see this company's total equity. Will take this. You note down somewhere and we'll calculate this. Company's total shareholders equity is how much? It is 73,733. It's in millions. Okay. This much is the company's total liabilities and shareholders equity. No, sorry. Total shareholders equity is how much? This is the owner's fund. Which one? 73,733. It's the owner's fund. Okay, and we'll divide by number of shareholders. Then I'll understand one shareholder how much we'll get. Okay. Yeah. This is according to the balance sheet we'll check, and according to the market how much we'll check. Okay. One is this. Next, value of certain and employees also missed in the back. Employees is also an asset, but we never show employees balance sheet. This is the value of the employee. And one more major disadvantage is historical cost method. We are using the asset in a historical cost method. Example, building we have purchased 10 years ago was 10 lakh. Might be because of some reason today the building value would have increased, but you can't increase in the balance sheet because it follows historical cost. That is one disadvantage. And balance sheet are prepared based on judgment and estimation. Some items are estimated. Bad debts is a estimate. We are not sure how many people will give. We'll tell 5% of them will not give. The estimation. Warranties is also estimated. We are not sure how much person will claim the warranty, but we'll estimate and write some liability. So judgment and estimate makes different company will have a different judgment. So that is also will affect your balance sheet numbers. And accounts may vary significantly few days before and after the publication. The balance sheet preparation date, reporting date, publication date, everything is different. So after publishing, something would have happened. So these are the limitations of the balance sheet we have. Clear with the balance sheet part? Any doubts on this? So understand this transaction analysis, very important. And equity part, 6 segments: current asset, current liability, non-current, current, non-current asset, liability, everything. That's it. So we'll take like a 20 minutes break and we'll start income statement. Online students, you can mark your attendance. You can mark on the same QR. And
For 1 minute. 18. We can.
it's same. So within 2 minutes they have to mark it.
Every 2 minutes will refresh actually.
Same QR only.
Same QR. Are you able to mark your attendance?
No?
What's it? Could also be the students who are marked it actually.
On like in real time.
Yes.
Hmm.
The students. That's something. 8 students. You marked that.
Recent scan Nidhi.
Nidhi, Nikar.
Marked it?
Yeah, I marked it from here.
Then it will
It
not.
should show up here actually.
So can I check the student details in this?
Yes, you should be able to actually. Rotates, rotate. Yeah, still figuring it out. Don't refresh it.
Right?
Yes. Yes. It will automatically will refresh. Why is it not refreshing? Try refreshing then.
So it will give a new QR or the same QR?
Doesn't matter if it's a new or something.
But they can mark the one. That
Only one.
I got it here.
Yes.
Nidhi one.
What's your name?
Srilekha.
Srilekha.
No.
Who's the online student?
Humaira.
Why?
No one's scanned.
You can mark them present also.
Oh, present and then
Manual.
no, that's
No,
it.
if you mark it present, it will
You
show
will-
manual. Yes. If they scanned it, it will show the scan.
So I just need to click it. That's it.
Yes.
Okay.
If you are marking it, make sure I don't think they are supposed to do it.
But we
Let
have
them mark
no. If I click it, it will mark.
Yes.
This is what L is what late.
Late. A is for absent.
So this I have to present off. Same way in between or
Same way.
present.
Once it is done, you can just close the QR.
Close the QR.
Yes.
So that means no
That
more.
means it will be closed. The same way where you'll be completing it, right? Close at times.
Now if I have to start, it will work.
If you want to again track attendance, you'll have to reopen it.
So once I've done with the class,
You can check out and
check
complete.
out and complete. And what about this?
That I don't think you will have to use anymore. So those prints will still have to update, I guess.
Sprints I'll text to operation team.
Operation. Okay, anything.
Comments, right?
Yeah.
That I'll text them.
Okay.
This one is done. Okay guys, so we completed we completed balance sheet. Now we have to start with comprehensive income and income statement. Okay. Should we start? So comprehensive income or and the income statement, we are going to discuss about this here. So comprehensive income means a total, and the income means other comprehensive income and all total, right? It's a like a umbrella term or a huge picture which says a comprehensive income, which means a change in equity during a period from a transaction other than like other events and circumstances from non-owner sources. Anything which is non-owner sources, comprehensive income, we discussed already. So comprehensive income include net income and all other comprehensive income. Two things. What and all will be having in the comprehensive income? Net income. Where you can find the net income? In which statement? Income statement. And other comprehensive income, like term. So net income plus other comprehensive income, if you sum it up, you will get what? Comprehensive income. Okay. So the components of comprehensive income include, these are the components in the comprehensive income. Okay. Revenue, expense, gains and loss. It looks like same, but it has a different meaning. So revenue, expense, gains and loss. The accounting statement is also created based on accrual method of accounting. We discussed already what is accrual method of accounting, which is based on the event occurred, not based on the when is the cash is coming in or cash is the going out. Okay. So income statement represent the result of operation for a specific period, like a movie tracking financial event over time. It's not like a balance sheet. Income statement is like a movie which has a climax which get finished this year and start next year again fresh zero. So this year my company made 1 million revenue, 1 million income or 500,000 as a profit. Next year when I start my income statement, I'll start from like a clean slate, start from zero again. But a balance sheet, how it start? From where I have ended, from there only I will start. But income statement is like a temporary account. Income statement is temporary account where all the expense, gains and losses are transferred to this temporary account. But every time in this temporary account, I can find income. So this income from the temporary account is transferred to permanent account in retained earnings. Retained earnings is what item? Balance sheet item, which is permanent account. So from the income statement, what I'll do, I'll get the income. I'll close the income statement. I'll take that money, whatever left, put it in the balance sheet. So each year or each period, whenever I'm closing this income statement, the income statement will give a gift to the balance sheet, which is profit. Like we'll take like an anniversary gift, which is given by the income statement to the balance sheet, and that income is transferred where? In the retained earnings. So at the end of the fiscal year, in the balance sheet will transfer, and the beginning of the fiscal year, the income statement again start with zero. From again Jan 1st, chalo will start from zero, and December 31st we'll make some amount as a profit. We'll put in the income statement again Jan, start new. So the income statement equation is income or loss is equal to revenue plus gain, expense minus loss, is known as income or loss. If it is positive, income; if it is negative, loss. So this term revenue and gain, expense and loss, you see, it is again like revenue, gain, it's like you're getting something, but they are different in nature. Okay. We'll discuss that. Now, as you know, the income statement have a format. In balance sheet, we saw the format, which start from asset, liability, equity, close it. Income statement, we have a two format: single step income statement and multi-step income statement. Single step income statement is easier, which it's not that complicated, where you have all revenue in one line, no gain, nothing, all revenue in one line. First line is total revenue. You have directly total revenue, then you have total expenses, which comes like gross profit or income from continuing operation. Income from continuing operation. Okay, so it says total revenue. Total revenue means sales, other revenue, gains, everything will come here. Next, all expenses, cost of goods sold, operating expense, other expense and loss in one line. We'll put it in one line and we'll close. We'll tell income from continuing operation, or we can tell it as a net income also. We pay tax, we'll get the net income. But there is one more line called as income from discontinued operation. Discontinued operation means we close that particular business. Okay, that one you have to show separately. You can't show any income related to that discontinued operation in this line. You have to show it separately. Example, you were selling to segment. We can put it in a segment. You are selling two types of products, or two separate product you are selling. You are selling electronic items, and also you are selling furnitures. You are selling electronic items and you are selling furnitures. Now your company planned to close the furniture segment. No more. We are no more going to sell the furniture. We are going to discontinue this. Suppose if I discontinue this furniture, can investor expect income from next year from the furniture? No. I'm going to close, right? Because of this, a proper communication is required. So we have to communicate to the investor, see, this year we have an income from furniture. From next year onwards, I am not going to have this income. So I will show this separately until this is a income from discontinued operation. And this is a income from continuing operation. This income you can expect next year also. Next year also this will be there. This segment will be running, but this segment will be not running. So you can't come and expect the same income next year. Give me the same income, give me the more income from the furniture, because I'm clearly telling you I don't have an income from this. So then whatever the income I'll have, I'll tell income from discontinued operation. Suppose if it is a loss, then I can calculate both is net income. Assume that if you don't have income from discontinued operation, or we are not discontinuing anything, only continuing operation done. Clear? So in a single step income statement, one grouping for revenue item or one line for expense, single step, only one subtraction is needed, done. But we will be using multi-step income statement. Multi-step income statement present operating revenue and expense section separate from non-operating. In single step, all income in one line, all expense in one line, minus pay tax, net income. But in multi-step, we don't have like that. Operating one, non-operating one. We look into the format. See the format here. Suppose assume that we are selling electronic items and furniture item, and we are discontinuing what? Furniture segment. Now what we are core business is? Our core business is selling electronic items. So anything which I am selling, I'll put in the revenue. Correct? What and all I'm getting, like income I'm getting from selling electronic item, I'll put in the revenue. And cost of goods sold means any expenses related to this revenue. To assume that I am selling speakers, electronic item as a speaker. To produce the speaker, what and all cost I'll incur. To produce speaker, what and all cost I want. Materials, labor, overheads. Overheads means extra, electricity, rent, depreciation, everything will come in the cost of goods sold. This is minus, okay? Here in USCMA we'll put bracket. Minus means we'll put bracket, means it's minus. So revenue, assume that we made 1 million from selling the speakers, and the expense we incurred 550,000, like cost of goods sold. So whatever is left out, we'll put it in gross profit. We'll put in gross profit. Now, not only this cost will be there. There is a sales guy, there is a delivery person, everyone, there is a sales office is there, advertisement we have to do, accounts we have to do. Everything is related to sales of the speaker, not nothing else. So that one will put in a line, selling general and administrative expense in a line. So assume that it was like 100,000. Okay. So we'll have something called as operating income, 350,000. Clear with the operating income? See, in single step, put everything in a line, all income, put everything in a line, all expense, profit. But here, revenue, cost of goods sold, gross profit, and then we have selling general administrative expense, we can tell operating expense. To put in a single line, we'll tell operating expense. After everything, we'll get operating income. This is the income I am getting by doing my business, by doing my core operation. Rather than this, I invested, my company had excess money, I invested somewhere, I gave someone loan and he gave me interest. No, like, are we doing investment business? Are we like doing any banking business, like giving a loan? No, but we do earn something from it, but is it operating? That is not our operation. From the operation, whatever I am earning, I'll put it till here. From non-operating, whatever I'll get, like interest and dividend income, I'll put it here. Next slide. And interest expense also will put after the operating income. Interest expense means to run the business, right? I would have taken a loan, or I'm paying a interest in a bond or on the debenture or on the bank loan, any interest, I'll put it here. Next, we have non-operating gain and loss. What is this non-operating gain and losses? Unfortunately, something happened, fire, accident happened, or unfortunately, like suppose what I did, I had a delivery van, I sold it, book value was 5,000, I sold for 7,000, I made 2,000 profit. Non-operating gain and loss. See, my job is not to sell the delivery van, my job is to sell the product, like the speakers. But fine, I sold one off time. It's not like every year I'm going and selling the delivery van. Sometimes I sold and I got 2,000 profit. Sometimes I may get loss. Those items will come after the operating income. Understand, these three things will come after the operating income. Then after everything, you will have income from, assume that from this I made 10,000 and interest I paid 60,000, which will be in minus, and I made a gain of 2,000. I will total this 360, 300, 302. Okay. Now I'm having 302 is called as income from continuing operation before tax. Income from, see, by doing this operation, this is the income I earned. That to continuing operation, not discontinued one. Income from continuing operation. Then obviously I have to pay the tax. Assume that we are paying 1 lakh of taxes. Okay, some tax amount we pay. Then whatever is left out is our income from continuing operation. So how much we'll have? 2 lakh 2,000. 202,000 is the income from continuing operation. By doing this business, I am taking how much? 202,000. Now we assume that we have a discontinued operation. Then only this portion will be there. Suppose if there is no discontinued operation in this year, no need to worry. This 2,02,000 is your net profit. That's it. Net profit is how much? Net income is how much? 2,02,000. But here we are assuming we do have discontinued operation. Suppose if we do have a discontinued operation, we have to report it separately. Okay. Gain from operation of discontinued component. Suppose I'm discontinuing, right? However, but I also would have done furniture sales something, and some expenses will be there. All expenses after everything, I earned like 1 lakh. Think I earned 1 lakh from this. Okay. Whenever I sell this segment, right, I am also selling the assets of this furniture. Furniture, I was selling in some building, and I was also having a machine related to manufacturing this furniture and everything. I did. This is from the business. And after selling everything, I got 20,000 profit from the asset sales. So what is the total gain I'm having? 1,20,000. Not only the business one you have to write. Close everything. I'm earning 120. But this should be written as net of tax. Here I am giving the tax. Okay. This tax is given for what? Continuing operation. For discontinued also you earned how much? 1,20,000. So you have to pay the tax on this amount separately. You're closing, not closing, doesn't matter. Government will tell you earned, you gained, give the tax. So assume that we will pay like a 30% tax. So what will be the 30% of this? 124, 36,000. Okay. We pay 36,000 in tax. So the income tax expense, here it is the expense. And they also written benefit. You see income tax benefit. Whenever you gain, you have profit, you have to pay tax. This is minus, obviously what I have done. Assume that from the discontinued operation, I made a loss. Example, I made a loss of 2 lakh. It's in minus, okay? Whenever I make a loss, okay, or whenever I have an expense, I'll get a tax benefit. Whenever I have a loss, the government will give that benefit to you. It's a 30%, so you'll get 60,000. So the net loss is how much? 1,40,000. Because you got a benefit because of this loss. If there is no loss, there is no benefit. Because you had a loss, you got a benefit. So 140 is the net loss I made. But here, how much is the net gain I make? Here you made 120. But 36,000 you made you have to pay the tax. So which means your net you made 20, 10, 16, 84,000. So 202 plus 84 will be your net income. So income from continuing operation plus income from discontinued operation will make your net income. Suppose if there is no discontinued operation, income from continuing operation will be equal to your net income. And there is a difference between operating income and income from continuing operation. What are the difference? These are the 3 difference. Operating income, see, we'll put the formula: revenue minus cost of goods sold, gross profit. Gross profit minus operating expense, operating income. Operating income minus non-operating items like interest and dividend income, interest expense, and non-operating gains and loss. And minus, you will get income from continuing operation before tax. Paid a tax, income from continuing operation. Suppose if I have a discontinued operation, net of tax I will write 84. It should be presented net of tax. After adjusting to tax, we'll write it. But you can't write all the tax in one line. Income from continuing operation, write separately. Here I paid 1 lakh separate. Here I am paying 36,000 separate. Like this, you have to write it separately. Clear with this income statement format, multi-step, and see this: sales minus cost of goods sold, gross profit, selling and administrative expense, income from continuing operation. Okay. Then you have other revenues and gains, other expense and loss, income before tax, income tax, net income. This is much more simpler version than this. We can follow this only. Okay. Elements of comprehensive income. The components in this, what and all we have: revenue, expense, gains and loss. See, what does a revenue do? A revenue will increase your asset. Revenue has a power to increase the asset or decrease the liability. Agree? Revenue has a power to increase the asset or decrease the liability. Both are same, right? Increasing asset and decreasing the liability, both are same. I mean, both are same in the means effect in the equity is same. I'm getting 1 lakh, or I have to give a person 1 lakh. Now I don't need to give. Both are same, right? Because I don't need to give 1 lakh. So on the effect, it is same. So revenue does that. How? Like, let me put in an example. Suppose I sold a product worth of 1 lakh. So I'll get how much? 1 lakh rupees. Or I want to give a person 1 lakh. But he told, I don't want a 1 lakh, give me the product. That is also sales. You give me the speaker. what I did, I sold him the speaker, but I didn't receive money. Like I owed him money, but now I no need to pay. So what does the revenue do? Revenue will increase the asset or do the liability settlement or decrease the liability resulting from what? Major or central operation. Not because of you give money or something. It is because it's from the company's major operation, delivering a goods or rendering service. In our example, by selling the furniture or by selling the electronic item, what happened? Either increase in asset or decrease in liability is known as revenue. Recognize only when the performance obligation is satisfied. We know this accrual method. Only when the performance obligation is satisfied, we'll record it. Or the customer gave 1 lakh, you didn't deliver the product. Doesn't mean you have earned it. It is not revenue. Okay. Now expense means it's an outflow or the consumption of asset. Opposite of the revenue. Expense means what? Outflow or reduction in the asset, using the asset, or incurrence of liability. Expense means it is decrease in asset or increase in liability. Both are same. Either my asset is going down or liability increase, my equity is affected somehow. Okay. So here example, we'll put an example. Suppose this one, rent outstanding. Rent outstanding is there. Is asset is decreasing? No, not yet, because we have not yet paid the rent. But is liability is increasing? Yes, because of expense. So expense means it's an outflow or a consumption of asset or incurrence of liability resulting from ongoing or major central operation. Because of the major operation, what and all happening to your asset, reduction in asset or increase in liability is called as expenses. Like recognized in the same period when the revenue we earned. Here, when we'll recognize the expense? I told the chair example, right? Whenever I sell 50 chair, I will put only 50 chairs cost expenses in my income statement. Same way, expenses you will record only when you have earned the revenue from that. I manufacture this table and I incurred 10,000 rupees as an expense, and I sold this table, then only I will record this 10,000 expense, or I will put this in my asset. This is not expense now. Gain, what does it do? Gain will increase the equity or it will increase the net asset, but not because of the central operation, not because of the major operation. It is from peripheral or incidental transaction. Your gaining or your equity is increasing because of non-operational transaction, not from a regular revenue or owner investment. Example, gain, I invested in a stock, I invested in Reliance, but my company is doing electronic sales, but my company had extra fund, I invested, I bought for 1 lakh, now the value 1 lakh 10, I sold, I earned how much? 10,000. Does that 10,000 is a revenue? I earned 10,000, right? I earned an income of 10,000. Is it a revenue? Revenue. Your net assets are increasing, your equity is increasing. I mean, your profit is increasing, but this profit is not increased by central operation. This happened by a peripheral or incidental transaction, a non-core activity. Same loss, opposite of it will loss. Decrease in equity from a peripheral or incidental transaction, not from a regular expense or owner distribution. So all transaction affecting a change in equity during the period are included in income. Any transaction which change your equity is considered as income, but excluding this. Transaction with owners. Transaction with owners will affect your equity, but does that mean it's an income? No, because it is excluded. Items reported initially in other comprehensive income. I told that we are going to discuss other comprehensive income, right? So other comprehensive income will change, but it doesn't mean that is a change in equity because of this. Okay, it's reported separately. Transfers to or from appropriate retained earnings. In retained earnings is what? Profit, accumulation of a profit. Sometimes what we do, we appropriate this profit. We set aside this profit and make it as a reserve fund, you know, like tell this amount is for this purpose. So my retained earning was 1 million. Then what I did, we appropriated it. 200% we kept aside. So there was a change in equity, but it doesn't mean it is an income. It was because of something else. It doesn't mean it is an income. Next is prior period adjustment. Prior period adjustment is something different. I'll explain this. Prior period adjustment means there was a mistake I have done in last year or last year I did mistake. Because of this, my profit I overstated. Last year I did a mistake. I should have recorded some expense. I have not done. Because of that, what would have happened? My profit would have overstated. If the profit is overstated, retained earnings is also overstated. Both are together, right? Now I want to make some changes in that because I written wrong. So I want to make some changes. So I'll change what? Retained earnings, which will affect my equity, but it doesn't mean it is an income. So this is excluded in the income. So change in equity, any transaction with change in equity is an income, but it should not from these 4 items. Clear? Okay. Next. So this is a difference between revenue and expense, gains and loss. Revenue and expense will from core business. Gains and loss, it's from the secondary activity. Selling company delivery truck or holding market fluctuation or natural calamities or something, it's gains and loss. See, you see this example. A retail bakery finishes the month with this event. Collected $10,000 from customer. I mean, this bakery, by doing a bread sales, they earned $10,000. Baking cost, $4,000 on flour, electricity and staff. Equipment sale, we sold an old delivery van for $3,000. The book value was $2,000. A storm broke out and the window broke and we spent $500. So in this, revenue is 10,000 because this was from selling operational, because our job is to sell the bread, and to make the sales I spent 4,000 in flour, electricity and staff wages. Yeah, obviously it is my expenses. And there was a van which was value was 2,000 in book, but we sold for 3,000. What is the profit we made? 1,000. That is not a revenue, that is gain, because that is an incidental transaction. It is not, it's a one-off transaction. Next, some storm broke a window, so we lost 500. That is a loss, opposite of gain. It's not expense, it is a loss. So if you want to present like this, sales, how much it will be? Cost of goods sold, 4,000. Assume that cost of goods sold, everything comes here, 6,000, and we don't have any operating expense. So operating income will be 6,000. Gain on sale of equipment. So this is 6 point. Income from continuing operation, and we before tax, and we pay tax. Here we are assuming there is no discontinued operation. So this is our net income. Okay, and these are the few items, other income statement items. These are few items which is like an adjustment we'll take. The one which we learnt only, but we'll name it. One is unusual gains and loss, which means unusual in nature or infrequent in occurrence or both. But it doesn't happen every time. Sometimes it might happen. Example, in the last example we saw, right? Delivery van. We are not going to sell the delivery van each year. We are every time, because of storm, every time window will not get damaged. But if it is happening, then it is different. It's usual. Sometimes something happened, a theft happened, a natural calamity happened, fire, like a flood. Because of that and all will comes under unusual gains and loss. Inventory write down. We had an inventory because of flood and damage. We lost the value of it. Or asset impairment. We had a building because of flood, something happened, or because of fire, something happened. The value of the building will go down, which is unusual gains and loss. So where we have to report this unusual gains and losses, it should be reported in income from continuing operation at the end line. I mean, not after this, before this. It should be, which one? Unusual should be reported before income from continuing operation. They are not treated as discontinued operation. Clear with this? Generally presented as non-operating gains and loss before this and after this. It is not operating, it is non-operating. So it comes in between operating income and income from continuing operation. See, the names look very similar, but meaning is different. Operating income, core operation, income from continuing operation means this year's business. In that, all these unusual gains and loss also will come. So you have to report here in between this. Okay, clear with this where you have to report? Okay, but we have some aggregation rules. Suppose we had a lot of unusual activity, unusual gains and loss, and if it is immaterial, you can add everything. What is this immaterial means? If everything is small, you can't trade everything separately. So what do? You aggregate everything. Because of fire 500, because of natural calamity 1000. But it depends on what company you are. Company is doing $1 billion business, for them 1000 is immaterial. But if the company income itself 10,000, 1000 is material, 10% of it. If it is immaterial, you add all the small item and put it in one line. But if it is material item, you show it separate. Like financial segment, it might report on a distinct line, and you have to report in the footnote why you are doing like this. The event: a commercial printing corporation experienced two activity: a fire damage warehouse which caused 15,000 loss, and management closed a small regional sales office. They are not closing the business. It doesn't come under a discontinued operation. Just one office they have closed, and incurring 20,000 severance package. So both are like unusual gains and loss. So which is both are unusual loss, and where you have to report before income from continuing operation and after operating income. So it's a other than non-operating loss. Other non-operating loss inside the income from continuing operation. Clear with this? Where you have to write? Next we have discontinued operation, which is like if a company is selling or sold or disposed or held for sale, also sometime we can classify that discontinued operation. We haven't sold it, but held for sale. We told that particular furniture example, right? I was selling electronics and furniture. I want to sell that particular furniture segment. I want to close that, but I haven't done it. But held for sale, we have some rules for held for sales. So this discontinued operation must represent a strategic shift. It is not like you're closing one shop or something. Example discontinued operation is assume that we have a business in Europe. Complete European segment we are closing. That is discontinued operation. A strategic shift means a major effect, not like a very small effect. Closing a shop and going, closing one branch and going. We are closing our UAE business. Complete business, if we close it, to have major shift. Example, suppose we know that a Ford, a company, a car company, they have closed their business. Okay, so when it's a strategic shift, so they have to report it separately, telling that this business we are not going to. We are not going to get an income from India. We are not going to get an income from Europe. So this is a discontinued operation. Okay. So example of strategic shift is exiting a geographical market, as I told, European market, selling of a major line of business. Our major line of business was electronic and furniture. Now we are closing the furniture, or dropping a major equity investment. We had an investment in some other company which we are earning income. Now we are dropping that. Something, if this is happening, it is called as discontinued operation. And how to report this? below continuing operation. You have to report separately, and that also you have to report net of tax. And in this, two things will be there. A gain creates an income tax, a loss creates an income tax benefit. I told example, that's it. And in that one line, we have to combine the item, an operating gain and loss from the component during the year. Normal business, how much I made an income, plus an actual gain or loss resulting the disposal of that component. By selling that company or by selling that geography, what is the gain and loss? I'll come put everything in one single item. If it is gain, tax expense. If it is loss, tax benefit. Net of tax, I'll report. You see this example. They are closing some European retail division. They lost 1 lakh from normal business activity. By doing a normal business in Europe, they lost 1 lakh. And by selling the asset, they lost 50,000 also. They sold an asset lesser than the book value. So total, how much they lost? Before tax, they lost 1,50,000. But we know that if it is a loss, what we will get? Benefit. So we got a benefit of 45,000. 30% tax rate, 45,000 we got. So what is the net loss then? 1,05,000. So this 1,05,000 we have to put in a single line below the income from continuing operation. So it's two things we have to understand. Write in net of tax, right after the income from continuing operation. Two rules. Okay, report it separately, that to report it net of tax. Okay, don't jumble this tax and that tax together. Separate tax. Okay, so this is how you will write. So income from continuing operation separate, income from discontinued operation separate, added. Suppose here I am having 1 lakh, here net I lost 20,000, so my net income is, see, income from continuing operation, and here I earned 10 but I have to pay tax 4, so I add 6, 24 plus 6, 30,000 is net income. So net income is equal to income from continuing operation and income from discontinued operation. Suppose I don't have discontinued, means continuing operation will be my net income. So what is this condition for discontinued operation is the component we told, right? A component can be operating segment, a separate business it was, or reportable segment. We had a business in Europe or something, we sold, or a subsidiary, or we had another company, we sold that company. Assume that my company acquired ArivuPro, then I sold ArivuPro. Whatever the income I was earning from ArivuPro, I will not get it, because this is not my company going forward. Okay, or asset group. Sometimes asset also be considered as disposable of discontinued operation. How it is, I'll explain this with an example. When you can consider an asset group, not one asset group as discontinued operation is, suppose I constructed a bridge from one city to another city. Suppose if you want to travel from this city to this city, you have to cross, like I constructed a bridge which I incurred $10 million. I spent $10 million. Okay. Now, then I'll put a toll plaza there. Whichever the vehicle is going, I'll collect. So I was earning income from this. Now I sold this bridge to someone. But to construct this bridge, 10 million, I took a loan. I took a liability of 10 million. Now I'm going to I'm planning to sell this bridge and tell someone to collect the toll. So what here is going to happen is I'm giving my asset and I'm giving my income, and I am also settling my liability. If this is happening, then only it is considered as discontinued. Not only like selling a car doesn't mean discontinued operation. So this asset group, I sold that bridge, toll plaza, everything together. So disposed of together in a single transaction with its associated liability. With the associated liability, I sold that particular business. Then you can consider as discontinued operation. Not only this, you have to, operational criteria should be there. It must be eliminated from ongoing operation. You told you are discontinued until that is operating under you. No, not considered. example, you have a restaurant where you have a dining, normal dining you have, and you have a fast food, which means you're discontinuing means you have to discontinue the fast food chain completely. It's not that both are sharing the same kitchen now. Separate. You're separate, owner is separate, I'm separate. So it must be eliminated from ongoing operation. The company must have no significant continuing involvement in activities. No involvement. If there is an involvement, it is not discontinued. And it must be either disposed, you already sold, or it is held for sale. Two things, either this or that. But for a held for sale, these are the criteria. To consider that as a held for sale, this 5 criteria should be there. I'm telling that I'm planning to discontinue this operation and I want to report it separately. Okay, you are planning, fine. Have you sold? No. But you are planning held for sale? Yes. If you are telling held for sale means this pack, like plan, program, probable, available and actively marketed should be there. Which means first we have to plan for disposal. Second, we have to locate for the buyer. And we are telling we are planning to sell, then we are sitting simply. No, we have to locate. A program should be conducted. And there should be a probability that we are selling this within a year. Then only we'll report discontinued operation, right? This year we will sell it. Then it is probable. Fourth, available. Asset should be there. I told I want to sell my furniture business, right? So the buildings and everything should be available. It's not like you are using it and it is not available for sale. It should be available for sale. Actively marketed. You should look for a buyer and you should have some reasonable price. You can't tell I'm going to sell and blank. If every criteria is done, then it is held for sale. Then you can report under discontinued operation. So go through this because there are a lot of conditions here. So first, a component. What is component they are discussing? And they are telling what is an operational status criteria. And it says either it should sold or held for sale. If it is sold, okay, no problem. No need to worry about this criteria. But if it is held for sale, this is a criteria. Example, in Jan to December is our finance period. And in the month of May, we are planning to sell this. Not sold it. We are planning to sell. Held for sale. And we are assuming that by February we will sell. Probability is there. By February we will sell. And in December we are preparing a financial statement. So we have to prepare as discontinued operation. Why? Because by February we will sell. Only in 2 months we are going to sell. But we have sold? No, not yet. But this criteria is meeting? Yes, meeting. Then continue. Okay. See this. A corporate restaurant group decide to get out of the fast food business. So they isolate the entire burger division, asset lease, local, everything. They have to separate it. You should not use the same kitchen now. Now they vote, will sell it. Then we can put the accounting treatment as discontinued operation of the year end. Okay. 2 items we learned now. One is unusual gains and loss. Second, discontinue operation. Next, third one is intra-period tax allocation. We already did. Intra-period tax allocation means allocating a tax within a single period. Suppose there is a tax. If there is a discontinued operation, so separately. If it is a continuing operation, so separately. And if there is a other comprehensive income, show separately. We'll discuss other comprehensive. Next is other comprehensive income. But if it is related to other comprehensive income, show separately. That is what intra-period tax allocation means. Okay. So where and all we'll allocate this? Income from continuing operation, income from discontinuing operation, and accumulated other comprehensive income. So the order is first give to continuing operation, discontinuing operation, and AOCI items. Accumulated other comprehensive items. Okay. Example you see, we paid $39,000 of bill. 1 lakh we made from a continuing operation. 20,000 we made from discontinued operation, 10,000 we made on AOCI item. 30%. What is the 30% of this? 30% of this 6. 30% of this. Okay, 30. Okay. And 30% of this 3,000. So total 39,000 we pay the tax. Clear with this? Done with the items. Now we have benefits of income statement. So what are the benefit of balance sheet? We clear, understand the liquidity, cash, and return, all this. But income statement doesn't tell all this. Income statement will tell the performance. If you see the word performance, it is income statement. It is not balance sheet. So evaluate past performance. Allow user to see how well the business did. Where you will see. If you go to the balance sheet, you can't see this. You have to see how we performed in the, it's like a marks card. Income statement is like a marks card. This semester, how much we have scored. Okay. Predict the future performance. By seeing this, we can predict future performance and assess the cash flow risk also. How we'll discuss in the cash flow statement. See, all income is not cash because we are using accrual method of accounting because event is occurred, income. But have we received the cash? No. But without cash, we can't do anything. Okay. So that risk you can tell. Limitations, yes. It runs on the estimate. Estimate means bad debt expense and all is estimate. And different accounting method. One company is using the depreciation straight line method and one company is using double declining method. Example, suppose both the company made 1 lakh income before depreciation. Okay, 1 lakh we made, but we had an asset of 50,000. This guy is doing 5 years depreciation and this guy is doing 40% depreciation. Okay, now according to 5 years depreciation, the depreciation expense will be 10,000. According to 40%, the depreciation expense will be 20,000. So here the income is 90, here the income is 80. Because of this different accounting methods, right? The numbers might be different. Okay, so this reduces the comparability. Now, can you compare this to company? No, because both are following different methods. Okay. Next, management judgment. Few things management will guess. The useful life. Do we know the useful life will be 5 years? What if it is for 3 years? So that management judgment will have. Omission of intangible value. The loyal customer, product quality. We never show the product quality in the income statement. So we are doing a sales, that's it. What if our product quality is better than some other company? That value you are not showing in the income statement, which is missing out. That is also part of performance only, right? And time of event, like when you are reporting this income, expense, everything, it depends. So these are the limitations of income statement and benefits. Clear with this? And this is also continuation of income statement only, a statement of comprehensive income. Any doubts still here? So we covered balance sheet and what is income statement. Now we'll cover the statement of comprehensive income. Now till where we covered till net income. Now we have something called as comprehensive income. Net income is not equal to comprehensive income. That is what we are going to cover. Any doubts still here? No. So now net income, this till here sorted. Now we'll add OCI, other comprehensive income. If you add this, you will get what? Comprehensive income. That is what we are going to learn. Okay. So comprehensive income means a change in equity other than non-owner transaction is called as comprehensive income. So in this, see, we have net income, right? So net income we already covered. So where this net income will get transferred at year end? Where this net income will get transferred at the year end? At least where it will go. Net income is reported where? Income statement or balance sheet? And it is transferred to under which equity, liability or asset? Where it is transferred? It's okay. Net income is in income statement. It is transferred to balance sheet. Till here is it clear? In the balance sheet, where it will transfer? equity, liability, or asset. This profit belongs to whom? Owners. So if it is a owner's fund, it will go to equity. That's it. Keep that understanding. So it will go to equity. In equity, we have 6 category. On which category it will go and sit? Retained earnings. 6 categories here, right? Common stock, AOC, like accumulated other comprehensive income, APIC, retained earnings, treasury stock. Then we have non-controlling interest. So this net income will go where? The net income going to retained earnings. Net income are closed out to the retained earnings. And one more thing we have is called as other comprehensive income. So this other comprehensive income is close to AOCI. AOCI is also a part of equity. In 6 category, retained earnings and AOCI is there. Net income will go to retained earnings. OCI will go to AOCI. So OCI items bypass the income statement. Bypass the income statement means OCI item will not go to the income statement. It will directly flow to the equity account. It will directly flow to the other comprehensive income. See, income statement we have, net income we have, it will go to the balance sheet under retained earnings, but OCI will not go. OCI will directly go to AOCI. Okay, accumulated other comprehensive income. So the nature of AOCI, now we are going to discuss the AOCI. Okay, accumulated other comprehensive income. So we know that AOCI is part of equity, and equity is a balance sheet. So all this is a permanent account. AOCI is a permanent account. Now, if OCI increase, AOCI increase, it's credit or debit? Credit, because equity item increase, credit, decrease, debit. That's it. So OCI item that represent a gain, which means credit. OCI decrease means debit, which means a loss. Because owner money, right? If it increase, gain, owner money. If it is debit means loss, owner monies are going down. So that represent decrease in net income. So the net dollar change in AOCI from the first day up to the last day represent OCI. AOCI will have beginning balance because balance sheet item, right? Assume that beginning AOCI is 1 lakh. Ending AOCI is 1,20,000. Increased or decreased? Increased, which means we have earned or we have lost. So other comprehensive income we have 20,000. This year we earned 20,000. Other comprehensive income we earned 20,000. That is what it changed. Suppose if it is 92,000 means we would have lost 8,000. From 1 lakh we would have lost 8,000. So the beginning and ending is affected because of OCI. This year's other comprehensive income. If it is positive, increase. If it is negative, decrease. Okay. How to present this statement? This is called as comprehensive income statement. How you will present is a question. Either you can continuously present. You present net income and you present OCI section. Fine. It's also fine. Or you present income statement separate and statement of comprehensive income separate. You present till net income you present, then you present comprehensive income in separate page. Both are acceptable. You present continuously in one line or one page, or you present here and separate. Okay. Example, see, a corporation start with AOCI balance of 10,000. What is my beginning balance of AOCI? Which means it's a balance sheet item, so I'll write 10,000 beginning balance. This year my company made net income of 50,000. Net income, normal net income 50,000. So where I will write this 50,000? Retained earnings, done. Good. And they have an unrealized investment loss, which is a part of OCI. So I had a OCI loss of 4,000. Now what is my comprehensive income? Comprehensive income is what? Not 6,000. So what is the formula of comprehensive income we learned? Net income, other column. So what is my net income? 50 plus, which means it was in a minus, 4,000 is in a loss. So plus into minus, we have to do minus. So 46,000 is my comprehensive income. This 10,000 is not income. This 10,000 is just the beginning balance. This year my beginning balance. And what is the loss I made? 4. So what is my ending balance? So AOCI ending balance is 6,000. For retained earnings, how much you will transfer? No. Entire 50. Don't worry, 46 you will transfer. Sometimes we assume 46 will transfer. Comprehensive income is just for the calculation. 50 minus 4. 46 is comprehensive income. Keep that in mind, leave. 50 you take, add in the retained earnings. 4,000 you minus in the comprehensive income. Ultimate effect in the equity will be 46. Assume our common stock was 1 lakh and my retained earning was 50,000 and this was 10,000. Total how much it was? 1,60,000. Okay. My effect should be how much? 46,000. Equity nothing changes. It was 1 lakh only. 50,000 was retained earnings this year plus 50. So my ending retained earnings will be, because beginning retained earnings plus profit is equal to ending retained earnings. That is what we learned. Next, AOCI I had 10, but I lost 4,000. Now my AOCI is 6. So what is total? 2,06,000. 1,60,000 and 2,06,000. What is the difference here? 46. This is how the effect is shown. Effect is not shown in a one line. Effect is shown in a two different line, in retained earnings and AOCI. That is what it is. Here it is written. Net income will go to retained earnings. OCI will go to AOCI. If positive, add. If it is negative, minus. So these are the different terms. Accumulated other comprehensive income means it's a balance sheet item which accumulates OCI item. How retained earnings accumulates net income, accumulated comprehensive income accumulates OCI item. Only other it varies only other comprehensive income, that to net of tax. You have to pay the tax, then you pay the tax means minus the tax, then you report. Next, other comprehensive income means revenue, gains and loss that are included in the comprehensive income but excluded from net income. Revenue, gains and loss is a comprehensive income only, but is excluded in net income. That is other comprehensive income. Anything comes in net income, normal net income. Anything which is not coming in net income, other comprehensive income. Comprehensive income means net income plus other comprehensive income, comprehensive. Statement is what we are reporting, this net income and other comprehensive income. Okay. Now we learn this other comprehensive income. We were telling, right? Other comprehensive income, other comprehensive income, other. What is this other comprehensive income? We'll see this example and we'll go through this other comprehensive income and we'll do the statement and we'll leave for the day. Okay. So these are the items in the other comprehensive income we have. First, see, no need to mug up. Understand what and all will come in the other comprehensive income. If you get a MCQ question, right? If they are asking, calculate AOCI ending balance, you should be able to understand what are the OCI items, because beginning will be there, ending you have to find, you have to add what? OCI. So what are the OCI items? We'll check. 1. Foreign currency item. Foreign currency translation adjustment, converting to a foreign subsidiary book from the US dollar. You see the word called translation. One is what? Translation. Gain and loss on a foreign currency economic hedge of a net investment in a foreign entity. 2. Gain and loss on a long-term intra-entity foreign currency transaction with settlement not planned in foreseeable future. Here, it doesn't tell only gain, it tells about the loss also. What is this translation? What are this foreign currency item is? Mine is a US company. Okay. I have a business in Europe. I have a business in Europe, or I have an investment in Europe. So here I'll do all the transaction in euros. Okay. But I'm not selling the business. Okay. Business is there. Foreseeable future, we are planning to run the business. But we'll report this in US, because the reporting country is US, right? Parent is US. So where you will report this, everything, income, expense, balance, all complete income statement we have to convert into US dollars. But we all know, because of the exchange rate, there will be a gains or loss. Assume that in this year, euro got stronger. Then will I get more dollars or less dollars? Euro got stronger. Think in the India's perspective. US dollar got stronger. You will get, when you convert into rupees, you'll get more rupees, because when euros are getting stronger, what happened? You will get more dollar. In our perspective, if dollars are getting, assume that you invested $100 initially. How much it was, like, okay, $1 was 80 rupees. You invested on $100. So you would have invested 80, means you would have invested like 8,000 rupees. 8,000 you would have invested. Now coming to that, it is 100 rupees now. Now how much rupees you will get when you sell? You are not investing anywhere, just you are holding dollars. When you sell the dollars, you are getting now 1,000, like 10,000 rupees. You invested 8, you are getting 10,000. Something bad happened to the country because our rupees are falling, but you earned it. So your investments are getting stronger. For the US, euro is an investment, because I'm a parent. My subsidiary is where? In the Europe. So if Europe, my subsidiary strong, my subsidiary country is strong, so when I convert back to the US, I'll get more dollars, which is gain. So here it is gain. Suppose if it is getting weaker, in 1 rupee, what, like $1 was is equal to 80 rupees. Now assume that $1 is equal to only 50 rupees. Initially to buy $1 you were paying 80. Now to buy $1 you are paying just 50. Cheaper. When if it is cheaper, means value went down. Think in that perspective. So $1 is equal to 50 rupees, but you paid $1.80. Now you will get only 50. Because why? US dollar got weaker, which means your investment got weaker. When your investment get weaker, you will get lesser amount, which is loss. But the question is, have you sold this European company? Have you sold the company? No. Still it is your company. So you are just converting in paper. You are not really converting cash. When you will convert in real cash is when you sold the company and you are bringing all the money to your company, to the US. But are you really doing this? No. But in the paper you are doing this. So you earned it. I mean, you income earned it, but have you realized it? No. The matter is about the realization. You have not realized it. So in the paper only it is there. Today if you sell the company, you will get money. Then it will be not in OCI. It will go to the income statement. But here you are just translating. The name itself is there, right? Just you are translating. Because of this, it sits in the OCI. Clear? Same with other investments, which is like foreseeable future, not planning to close this and all. Not planning to close this foreign currency transaction. So you just let it be grow. Because of this, gain, loss. That's it. One is foreign currency item. Next is derivatives and hedging. A very detailed topic is about the derivatives. It's not that required, but let me put it within a simple example. Derivative. Okay. Derivative, here item 4 and 5. Gains and loss on derivative instrument designed and qualify as cash flow hedge. Okay. Fair value change of excluded derivative component in a qualifying hedge relationship, amortized under systematic method. See, a very detailed derivative is separate topic in your section B part 2. A derivative, it's come like 2 to 3 hours class we have, but here in a simple, you invested in a derivative. Derivative consider as an instrument. and you earned something. But earned means you haven't sold it yet. You have not exercised it, but it is gaining. The value increased. The particular derivative value increased. Because of that, you earn something, but you have not yet realized. So that is a income. This is a simple version. But what is derivative? If you want to put, suppose you're manufacturing furniture, right? You want timbers. Okay. Today the ton timber is $1,000. Today the value of timber is 1,000. You want timbers, but you go to some raw material provider. You tell, see, you don't want timber right now. You want after 6 months, but you are afraid of increase in price. So you go to him and will fix the price. I'll give 1,100. No, whatever the price after 6 months, he have to give the timber for how much? 1,100. And you have to go and purchase after 6 months for how much? 1,100. What if the value of the timber is 1,000? You are forced to pay 1,100. If the value of the timber is 1,500, you just pay 1,500, enjoy 400. Correct? So in the time between from first month to 6th month, the timber value will keep on changing. Suppose if it is a profit side for you profit side means what? The timber price should increase. Then you pay less, then you make a profit. But still you haven't exercised. The matter is you have not exercised it. You have not used it. The value keep on changing. Then the derivative value keep on changing. So that change in value will report gain or loss. That is OCI. Okay. Next, same debt securities, very important, because when we discuss about marketable securities, right, current asset, it will come. You see this word called AFS, unrealized holding. Which security it is? Debt, not equity. See, security means an investment. An investment come in two securities, major two securities, gold, land, everything is there. But here, investment in marketable securities two. One is debt and one is equity. Either you be a shareholder or you be a debt holder. Debt holder means give loan, buy the bond, or shareholder means you give the share. Here it's about the debt security. You invested in a security and you are classifying that as available for sale debt security. Available for sale debt security means whenever you want you will sell. Your intention is how? It's available for sale. I want to sell tomorrow, I'll sell. You don't have an intention to hold till maturity, because this debt security will have a maturity date, like a FD. Someday it will get matured. It will tell 2028 December 31st you will get your money. Like that, maturity will be there for debt security, but for equity no maturity date. You can't buy Reliance share and wait Ambani to pay you till on that particular maturity date. Whenever you want, you sell it based on the market rate. But debt will also change its value, but on the maturity date you will get your money. So unrealized holding gains and loss. What is unrealized, not yet realized, holding gains and loss on available for sale securities. Suppose I bought a bond, which is a debt. I bought a bond for, one bond was equal to $1,050. I bought for $1,050, which I have categorized as AFS. There will be different types of categorize this: available for sale, held to maturity, trading security. But this is about available for sale. If it is comes under available for sale means whenever I want I'll sell this. Debt security, it should be available. Any price increase and decrease, it's considered as unrealized holding and it will go to OCI. And unrealized gains and loss, transferring a debt security from held to maturity to AFS. You had a held to maturity security which you are planning to hold till maturity. That doesn't come under OCI. That have a different valuation method that we'll discuss. Now we'll discuss about AFS only. You had a held to maturity security, now you want that as available for sale. It is now available for sale, right? Now use this rule. Any increase in decrease in the gains or loss in this. So now the value of that particular security is 1,100. So you gained how much? $50. But have you realized it? No. Then it will go to OCI. 3 things covered. Yeah, derivatives, debt security covered. Next, this one. Pension, insurance and credit risk. What is this pension? Pension and post-retirement gains and loss not recognized immediately. So this pension funds and all will be there for the employees, right? That one will invest. So which is not going to be recognized. Suppose it increase the value, we recognize this. Or sometimes the cost of pension will increase. So cost increase means expense increase. But you don't need to pay right now. You have to pay when the time comes. So that is also considered as OCI. And credit risk means that's in the paper. Okay, you gave a loan. I mean, you issued a bond. Your company bond you issued for 1,000. Like you issued like 1,000 bonds. Okay, so which means 10,000, 1 million it comes. So issued 1,000 bonds for $1,000. You got 1 million from the bondholders. And in 5 years, what you have to do? You have to pay back their 1 million. Credit risk means, suppose someone have rated your bond very less. When they rate your bond very less, what happened to your bond value? Decrease. So assume that the bond value went to 950. Then 1,000 bond value means you have to pay only 950. Now tell me, is it a gain or loss?
Gain.
It's a gain, because now you have to pay back only 950. Yes. Now you go to market, you slowly go to market and call all the bondholders. 950 is the market value, take the 950. That is called as, because of the credit risk, a fair value change of market risk benefit caused by instrument specific credit risk will come in OCI. Okay, clear? So that's it. So understand, one is pension, insurance fund, credit risk. This is very important. Debt securities available for sale. See, debt securities, again, first security we categorize into 2. What and all is this? Where it is? Debt and equity. Again, debt investment will categorize into 3. One is AFS. I just told, available for sale whenever I want. Next is HTM, held to maturity. Whatever matter, whatever price increase, decrease happen, I'll hold till maturity. That one you don't worry about OCI. Next one, trading. Trading means for short term purpose they will invest and take back. Speculation, risk they will take. Short term purpose. That will also not come under OCI. That will directly go to income statement, because that they will realize instantly. Trading securities, suddenly they will realize. AFS, they don't know when I am going to sell. I'm going to sell today, tomorrow, or after 1 week, don't know. Held to maturity, I have a clear vision. But AFS is in between of these both. So because of that only it comes under OCI. Clear with this? Now you know where to record the OCI, and you also know like what are the OCI categories. So OCI is simply recorded like this. So beginning, accumulated other comprehensive income, this is like a book. And you bring OCI plus, or if it is a loss, you do OCI minus, you will have closing OCI. That's it. So this is the income statement look like statement of comprehensive income, revenue, gross profit, operating expense, minus all, you will get operating income, then non-operating gains and loss, then financial income and expense, which means interest and dividend income, interest expense, everything. Then you will get income before income tax. Then you pay tax, then you have net income. This is one method of presenting. I told, right? Continuously you present. This is method. See, then you report other comprehensive income. How much was the other comprehensive income? See, here available for sale of debt securities, they earn 97. And only one, it is not necessarily all items should be there. Only 1 or 2 items. So 2,125 net income plus other comprehensive income will make comprehensive income. See, 2125 plus 97, 2,222. Okay, that's his comprehensive income. This is Apple's income statement. You see there, net sales, cost of sales, operating expense, then you have operating income. That's it. Now other income they put it in one single line: income before tax, pay the tax, net income. Clear? Okay. This is done. See, here they have stopped till net income. In this, they continued in one page, but here they have stopped in one page and started a comprehensive income as separate page. Here they are showing just statement of operation. By doing the operation, how much I earned. Here what they'll do, they'll start from net income. The same net income is there, right? They take this, put it here. You see, currency translation. Obviously, Apple is a multinational company. They will have a currency translation. See, by just an exchange rate, they earned 267. They lost 267 in millions because US dollars are stronger. According to them, India is the weaker because Indian rupees are falling. Not only India, but other currencies also might be falling. So because of them, they are making losses. Not actual. This is only in paper. Okay. Unrealized gain and loss in derivative instrument. Here they earned. And total this is change in fair value of marketable securities. That available for sale I told, right? This one. And like this they will make this. The total comprehensive income is 1. See, net income plus other comprehensive income. This 1,600 is there, right? This is other comprehensive income. Net income 112 plus 1,600 will make 113,600. That's it. Clear with this? Any doubts still here? So we covered what and all statement and what on, like what and all we covered. We understood what is in the section A we have. Okay. Then we understood the financial reporting. They understood US GAAP and IFRS. US GAAP is what based? Rules based. IFRS principle based. Done. Then we learned users, 2 dimension. Indirect users versus direct users, external and internal. Then we understood the elements. Then accrual accounting, very important, accrual accounting. Then we understood the 4 financial statement. What are the 4 financial statement we have? Balance sheet, income statement, cash flow statement, then not only statement of changes in equity or capital. Okay. Then we discussed complete balance sheet, 3 elements of balance sheet, what and all? Asset, equity, classification, non-current asset, current liability, non-current equity, 6 categories. The one category just be capital stock or common stock, accumulated other comprehensive income, just the one this KPIC, paid in capital, additional, any capital paid more than par is additional paid in capital. That's it. 3. Next, one more important thing just discussed. AOCI done. Where does the net income go? Retained earnings. 4 things. Then 5 and 6 very odd. Non-controlling interest if we have a consolidation, and contra equity. What is called as, what stock it is? Treasury stock. No, not yet. Where it is. Here it is. 6. This one. 5th one. Treasury stock. Contra equity. What does treasury stock means? A repurchase of share. I told that example, right? 10 shareholders are there. I gave money to the 2 shareholders and told you can live off the own share. So what happened? Cash reduce. Here equity reduce. See, if it is contra asset, asset reduce. Contra equity, equity reduce. Okay. Is the 6 different categories. It's very important because the next topic, statement of changes in equity, right? If you know this, the particular entire topic is easy. Okay. Then 6 categories done. Then we learned about income. Like comprehensive income means what? A change in net asset. Any transaction which changes in net asset excluded from owner transaction. And formula of comprehensive income is net income plus other comprehensive income. Okay. And multi-step income statement, we learned 3 items: unusual gains and loss, discontinued operation, discontinued operation, and intra-period tax allocation. Where on all 3 taxes will allocate?
Discontinue, but
The last one we just learned, OCI, to the OCI. Okay, that's it. Then we understood this OCI items: foreign translation, pension,
insurance, credit risk,
credit risk, insurance, credit risk. Then we have this
derivatives,
derivatives and hedging, and last one, the AFS, available for sale. And see, available for sale. Translation opposite is remeasurement. If you see the word foreign currency translation, OCI, foreign currency remeasurement, it will go to income statement. Okay, translation will go to OCI, remeasurement will go to income statement. If it goes to income statement, where it will go? It will impact your net income and it will impact your retained earnings. OCI direct, AOCI it will impact. The remeasurement is also translating your foreign income statement only, but there is something called as currency of record and currency of operation. We record in one currency and do a business in different currency. But do you really think where the impact will be there? In the record there will be an impact, in actual, or in the business there will be an actual impact? In the business. So but we would have we recorded in some other currency, but actual happened something. That is that recording to actual is there, right? That is called as remeasurement. Then there is actual money in something happened. Because of that only it will go to income statement. It's a part 2. We have this this topic, like there only we are analyzing the income statement, right? What if it is a foreign, like if it is an Apple, it's a foreign MNC, right? So for there we have a translation. So for a person who knows a translation, fine. The translation minus means there in part 2 we'll analyze why it is minus, how to read that. So reading the financial statement is done in part 2. Here just we are preparing. Okay, fine. So tomorrow we'll do this equity, statement of changes in equity, cash flow, and integrated reporting. Like this we'll complete the first module, basic financial statement. Any doubts still here? Clear? So by tomorrow we'll try to complete this external financial statement, and next week we'll do current asset, then non-current asset, liabilities, equity, and revenue. Okay guys, thank you for the day.